When the economy's in trouble, you use your fiscal cannon to deal with that challenge. We're now in an ambiguous moment.
The markets are kind of hinting that the Fed may be making a mistake by moving too early on the taper.
The biggest driver, I think, of growth slowing is the fear of restrictions from the Delta variant.
When it is your hard-earned money as opposed to tax dollars, it takes a bigger hit to that mental outlook.
There's a ton of cash on consumers' balance sheets and corporate balance sheets. That eventually needs to go somewhere.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is a risk-off Thursday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market down 25 on the S&P. A bounce off the lows, Tom. We're down 0.6%. Bit of risk aversion breeding through this market worldwide.
Risk aversion, we go out to the deepest market, the dollar. The dollar really breaking out and moving stronger. Renminbi out to 6.49. John, BBDXY really up at the strong part of the range. It's a correlated weakness.
Tom, the cyclical breakdown's been building for a while. Look at energy, both credit and equity. Look at the move in airlines over the last couple of months. That's not the Fed. That's Delta. That's China. I think blaming the Fed every single morning there's any kind of move like this is probably missing the mark.
Totally agree. Here's the mark, John. Let me put it up here. I threw these out about 2 weeks ago in celebration of our great epidemiologists, our virologists. You know what, John? We've all got these back on our face. On radio, I'm holding up a mask.
September becomes October, November, December, maybe January. And Lisa, in line with the Goldman forecast, in the past 24 hours, a downgrade for Q3 GDP in America, an upgrade to Q4. They don't mention the Fed. They're talking about the Delta variant.
And frankly, this is the right focus. I think it's really important that you come out and talk about how this is not about the Fed and tapering. This is about supply chain disruptions. This is about inflation that's reducing consumer sentiment. We've seen that across the board as well as production. Interesting to see that people are finally coming out and seeing the potential ramifications for this. The big question in my mind, John, how long do these disruptions go on at a time of zero tolerance for COVID cases in the likes of China?
Well, China, front and center. And Tom, a conversation about wealth distribution, redistribution in China as well. Look at the move over in Europe. That's where the big move is right now. Look at the move in France. Look at the move in the luxury players. They're getting absolutely hammered.
Well, yeah, I'll go with the China linkage there. And the first thing I looked at this morning, John, was the Germany 10-year yield, which has really given me some greater negative statistic. John, the single thing I've noticed in the last 24 hours, I've never seen this. We have economists playing epidemiologists. Jan Hatzius at Goldman Sachs, who I adore, he's wonderful work. Read the note, John. He's guessing the Delta variant. I don't buy that. It can cut either way.
Tom, we'll catch up with Neil Dutter of Renmac a little bit later this morning, and Neil's saying the same thing. This was Neil out on Twitter in response to that Goldman call. This is a forecast to rent, not own. We will be trading a bit more COVID risk in Q3 for a lot less COVID risk in Q4 and early next year. And that's the market bet, Tom.
It's a bet.
That's it right there.
Well said.
Do you
It's a bet.
expect this to reverse, and do you want to lean into the weaknesses you see on the screen?
No, it's absolutely a bet, and we see it now. Doug Cass out on Twitter this morning nibbling at Amazon. He's been a massive short. Even he's stepping here. John, it's a massive drawdown.
Let's get to that drawdown, Tom. TK, we're down 25 on the S&P. We're negative 0.6%. Yields lower by a couple of basis
points. The Dow
points.
down 221.
Let's call it 3. 123.17. Do you want me to do the Dow, Tom?
Please do the Dow.
No chance. FX, euro dollar, 116 handle. Lisa, 116.92. We're down there by a little more than 0.1%. And just to round this out, Lisa, crude with a 63 handle. Yeah. We're negative there for 6 straight days.
Yeah, and this to me is really one of the key indicators. I mean, where we find the risk-off feel is not in the huge drawdown necessarily in the S&P that we're seeing, but rather in some of the commodities, in some of the dollar complex area where you see that dollar strength rise to the most this year, as Tom was talking about. I want to give you an indication, though, of the potential slowdown that we're looking at, and whether we've actually seen this in the labor market is unclear. Toyota Motor overnight said that they were cutting production by 40% in September because of supply chain disruptions, because of that chip shortage that they see continuing for a while. Do we start seeing a pickup in the layoffs as a result of the increase in the Delta variant, in a result of the increases that we're seeing in supply chain disruptions? People are expecting those initial jobless claims to continue to decline, as well as the continuing claims. But do we see any upside surprise, the wrong kind of upside surprise, as we see the Delta variant start to take hold? Also today, all day, Tesla is having its artificial intelligence day, sort of awkward timing given that this week the U.S. officials began an investigation into their autonomous driving self-driving technology? Will we get automatic cars? And will they give a sense of whether their timeline is pushed back due to the chip shortages, due to some of these supply chain issues? And then at 10 a.m., we get U.S. July leading economic indicator index. And the interesting thing to me is how much do we actually start to see some of the issues bleed into consumer confidence? How much are people getting ahead of that based on what we saw in that Michigan survey that really shook a lot of people in the market last Friday, John?
Lisa, thank you. We've got to digest and process so many things this morning, Tom, and I wonder if you can reconcile them all. Can you reconcile these two things? Delta threats to growth and the Fed tapering. Can you have the latter without the former?
I think the overanalysis of the Fed, given the body of moving events we've got, including Afghanistan, John, is just, frankly, it's unfair to Chairman Powell. I think the media's over, this distinction, John, taper and rate rise, we're divorced in that. We're just trying to get a GDP handle for Q3 and Q4.
Let's bring in Ian Shepherdson to do just that, Pantheon Macroeconomics Chief Economist. And Ian, let me rephrase that question. Can you have the latter with the former? Can the Fed taper if we're also discussing the threat of a slowdown because of the Delta variant?
Well, I certainly don't think they can taper very quickly. I mean, it's pretty clear from the minutes yesterday that back in late July, the last meeting, that there was a split of opinion already on the Fed, and the word Delta was cropping up a lot more in the minutes than in the previous meeting. My guess, if they had a meeting today, they'd be talking a lot more, even more about Delta, because just in the 3 weeks since the July meeting, the numbers have deteriorated pretty dramatically across the sort of southeast quadrant of the US, and cases have risen in every state. And I think that on that basis then, that looking for an early taper or for a clear steer from Chair Powell at Jackson Hole, I mean, I think that's very premature at this point. We have to keep an open mind. We just don't know what the path of Delta will be, though I would point out that in the two states where it became rampant first, which was Missouri and Arkansas, cases are now falling. So it took 2 months from the initial pickup to the turning point, so early June to early August. If that's a template that's followed elsewhere, then it's reasonable, and we're guessing here, but it's reasonable to think that by the end of September, early October, the Delta wave nationally will clearly be coming down, and that might clear the way for the Fed to announce tapering in the early November meeting. But this is very speculative, and it's entirely possible, as some of the FOMC members pointed out yesterday, that they might have to wait until early next year, because the uncertainty is great, the impact on the economy at this point is unknown, and for all that we might speculate that Delta will be going by October, we don't know, and it could get a great deal worse before it gets better.
Ian, I noticed overnight repo going out to a new high, well above $1 trillion. I don't want you to play bond guy or overnight repo guy, but I want you to explain how the wall of liquidity out there changes the discussion for Chairman Powell.
Well, the liquidity is everywhere now. So, we see it in the markets, and you can see it in the repo market. You see it on consumer balance sheets. You see it on household balance sheets. You see it in elevated asset prices. So, and elevated housing prices as well, of course. So there's an unprecedented amount of liquidity everywhere. A lot of it seems to be kind of on the sidelines. We're not seeing households deploying their excess liquidity, and we're seeing some corporate spending, but it's not rampant. So it's not as though, taking away liquidity or adding less. Tapering, remember, is just adding less liquidity. It's not taking anything away. It's not clear to me that it would have any meaningful impact on the real economy, but of course it has a massive potential impact on market expectations, perceptions, and again, as some FOMC members noted yesterday, it's very difficult to separate the idea of tapering from tightening. And the problem is that if you give the markets an inch by starting to taper, then they take a yard and start fretting about imminent rate hikes. And however much the Fed might want to push back against that idea, once that hair is running, it's very hard to stop it. So, in that case, if you want to be cautious and you're worrying about Delta, don't start the hair running immediately. Wait until Delta has subsided. After all, the last core inflation print for July showed that spike is really, the reopening spike is beginning to recede. We're seeing a pickup in wage growth, but we're also seeing strong productivity growth. So the unit labor cost environment is pretty favorable. And so I think to make this argument that the inflation spike might be transitory, I think is a solid idea. And in the face of the Delta uncertainty, why not wait a couple of months? What difference does it make?
Ian, good to catch up, as always. Ian Shepherdson there, Pantheon Macroeconomics Chief Economist. Lisa, why not wait? Why not wait until September 3rd for the next payrolls report? What can Chairman Powell say next week?
Well, the incredible irony here is that the longer that the Delta variant continues to be a problem, we're seeing more inflationary pressures on the margins when it comes to some of these supply chain disruptions. How does the Fed deal with that, right? How does the Fed deal with the fact that consumers are getting less buying power in the store? Can they really affect anything with that? What does it do to not taper in order to stimulate the economy? I'm just struggling to get my head around how the Fed addresses issues that are way beyond their control.
And many people are asking the same questions. Let's ask the question of the data. Lisa, you've followed the consumer confidence data far more than I have over the last couple of weeks, the last number of months. Last Friday, the weakest since 2011. And the question I think a lot of people are asking, every time we have a downside surprise in the economic data, a higher price is now starting to crimp demand, weigh on confidence.
Well, and we've seen that in specific industries, and frankly, other data that we got out this week confirmed that really disappointing read that we got, where basically higher prices are crimping people's willingness to spend. You're also seeing a runoff on the stimulus checks. You're also seeing a great disappointment that we're seeing a resurgence in the Delta variants, and you're seeing this in home builder sentiment. You're seeing that in the retail sales disappointment. There is a series of data points that really confirm this, John.
If there is a consensus right now, Tom, on this economy, it's recovery delayed, not derailed. And that was the view from Goldman overnight, I think.
Yeah, and John, I would go out further, and this goes to what we've seen from J.P. Morgan, from Goldman Sachs, and others, is the measure of where we land. And I really want to emphasize Goldman Sachs 2022 is not only where we land lower GDP, but it's the deceleration to get there.
What do you want to own in this market? We'll ask that of Stuart Kaiser at UBS. He'll join us in the next hour at 7 a.m. Eastern Time. Here's the price action. We're down 24 on the S&P. We're negative 0.55%. Yields are in. Treasuries are bid. We're lower 2 basis points to 123. And in the commodity market, we've had 6 days of this now. 6 straight days on the run for crude. Lower, down by 3% at 63.54. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden will keep U.S. troops in Afghanistan until all Americans are able to leave the country. That's even if it takes longer than his August 31st deadline to withdraw. The president also told LBC News that U.S. intelligence didn't foresee such a rapid advance by the Taliban and collapse of the Afghan military. The president of Afghanistan says he fled the country over the weekend to avoid being hanged. Ashraf Ghani is now in the United Arab Emirates. He says he left on Sunday after security officials warned him that Taliban fighters wanted to execute him. Ghani denies reports that he left with a helicopter full of cash. Most Federal Reserve officials agreed last month they could start slowing the pace of bond purchases later this year. That's according to minutes from policymakers meeting last month. The officials judged that enough progress had been made toward their inflation goal and gains had been made on employment. A new study says that coronavirus vaccines are less effective against the Delta variant of the disease. That could lead to a push for booster shots for fully vaccinated people. The British study that the Pfizer and BioNTech's vaccine lost effectiveness in the first 90 days after full vaccination. Goldman Sachs is expanding its presence in Europe. The firm has agreed to buy the asset management arm of Dutch insurer NN Group for around $1.9 billion. About 3/4 of the business's $355 billion in assets are backed by environmental, social, and governance criteria. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I don't think it could have been handled in a way that we're going to go back in hindsight and look, but the idea that somehow there's a way to have gotten out without chaos ensuing, I don't know how that happens.
The President of the United States speaking to ABC from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your equity market, a price action this Thursday. Risk off, we're negative, we're down, we're lower, softer. Lighter on the S&P 500, we take a bit more weight off it, down 0.6% on the S&P. Yields come in 3 basis points to 122.83. The dollar is stronger. DXY comfortably with a 93 handle this morning. Outside of that, Tom, crude lower, negative, down 3 percentage points to 63.33 on WTI. That right there, a 6th day of losses on crude.
Yeah, there's no question about that. And to take it over to the global price, maybe what China worries about, Brent crude from 70, John, down to 66.33 as well. Washington is turned upside down in this August of 2021. Picking up the pieces, Anne-Marie Horton is in Washington this morning. Anne-Marie, let me start with a simple question. What's on the president's agenda today? Which pieces does he begin to inspect to pick up?
10 a.m. this morning, we know that the president is going to be meeting, Tom, with his national security team. So that his NSA advisor, Jake Sullivan, that is the chair of the Joint Chiefs, Mark Milley, that is Secretary of Defense, Lloyd Austin. And of course, this is as they continue this evacuation from the Kabul airport of American citizens as well as Afghans. So that is going to be number one agenda. I expect the White House to tweet another photo, this time of the president, though, in the Situation Room.
How do some of President Biden's comments read out in the Beltway right now when you have a president who said, no, I don't think it could have been handled in a way that we're going to go back in hindsight and look, but the idea that there's a way that we could have gotten out without this chaos is misguided. What's the reaction among politicians in Washington?
Frustration and confusion, because this administration had assured politicians on both sides of the aisle and the American people, the president himself, July 8th, saying you will not see scenes of Saigon, and it is not inevitable. That is a quick Taliban takeover. And that's pretty much almost exactly what did happen. So there is this frustration. And I would note in that interview with George Stephanopoulos from ABC, the president had a tone of vexation. You could tell he was quite frustrated and defensive on what is going on right now and how this is all playing out. The bit that actually really caught me was when George Stephanopoulos said, we've all seen those pictures, that C-17 filled with Afghan refugees. And the president cut off Mr. Stephanopoulos and said, that was 4 days ago. That was 5 days ago. Potentially the president doesn't realize those images are still very much on Americans' minds and politicians' minds.
All right. So does it matter that there's deep frustration among Washington politicians? Does this bleed into the domestic policies? Does this bleed into international relations? Or are President Biden's opponents making a lot of this to try to get that to be the case?
There's always going to be politics at play, right? This is Washington, D.C. They don't call it a swamp for nothing besides the mosquitoes. But domestically, this is a cloud over his agenda. Already next week, there's going to be hearings. Already we have Speaker Pelosi and Senator Mitch McConnell saying they want the Gang of Eight having briefings with top administration officials on what exactly went wrong. And Lisa, to your point on the international front, there seems to be some relationships that are frayed. You could feel the frustration from the Europeans. Armin Laschet, and we have a German election coming up, he is likely to be the next chancellor of Germany, said this is the biggest debacle NATO has ever seen. So you could see there's going to be a lot of reconciliation after this needed on this side of the pond and, the international players.
Let's go to your sojourn in London, Anne-Marie, and the idea that maybe you have a handle on transatlantic a little better than I do. I note the Wall Street Journal, no friend of the president, brings up the debris of Robert Gates, the acclaimed Secretary of Defense, and his harsh criticism of the president over the last many decades. They talk about COVID. They talk about characters being Biden's strong points. And then there's a criticism of people like Robert Gates. Does that force Europe to call an emergency G7 meeting?
Well, they have already. The Prime Minister of the United Kingdom says he wants a virtual G7 meeting, and that is likely what we are going to get. My question regarding the G7 is in early June, when the Taliban actually had control of more districts than the government, much of the country was still contested, but still what was in the Taliban control was much bigger than the government's. The G7 at that moment was meeting in Cornwall. Why was this not discussed?
Well, I'm going to look at this. And again, folks, Admiral Stavridis will be with us on Bloomberg Surveillance on radio in the 9 o'clock hour, I believe. Anne-Marie, Stavridis in Time magazine was just flat out scathing. There's no other way to put it about how we blew it in Afghanistan with 1 year tours of duty like we did in Vietnam. Yes. What's the Pentagon say about this? I mean, I haven't heard a word out of the Pentagon. They're on radio silence.
Well, Admiral Stavridis was calling it delusional America, and he also went back and showed that the Soviets tried this, the Americans tried this, heck, Alexander the Great tried in Afghanistan, and it's just not happening. We heard from the Pentagon. We heard from the Pentagon yesterday. the thing that stuck out for me from the Pentagon was General Mark Milley talking about the fact that we knew that it could be a quick takeover, but the quick takeover was going to be months. No one knew it would fall in 11 days. So that bit of intelligence was interesting. Another point of this briefing was reporters pressing them about why did we leave Bagram Air Base in early July? Wouldn't Bagram Air Base, with its 2 runways, be a better place to evacuate Americans and Afghans? And General Milley said that's a great question.
Anne-Marie, we've got to leave it there. Our Washington correspondent down in Washington, D.C. Anne-Marie, we'll catch up a little bit later. Let's look at this market. That's where the moves are. That's where the attention is for our audience right now. We're down 24 on the S&P. We're negative 0.5%. Yeah. A story that has not been talked about enough this morning. In China, there has been a high-level party meeting led by Xi that is asking for high-income groups to give back to society more. Tom, it is so important to look at this move in Europe and look at the names. It's Kering, down 7%. It's LVMH getting absolutely whacked, down by 4.6%. It's the miners, it's Anglo, it's Antofagasta. For the last 5 years, most growth scares have been born in one country, Tom, China. And that's the story again this morning over in Europe. It's why the Stock 600 is getting absolutely slammed, and it's down 1.75%.
Well, there's the political moves here in China, including the headline out moments ago across Bloomberg. China regulators ask Evergrande Group to resolve debt risk. So to me, it's a stew in China. More, John, and it does speak of can they make the 6% GDP bogey? And like in here, it's up in the air. I don't have any wisdom on that.
We got a threat of slower growth, 1. And then 2, on top of that, Lisa, you've got a conversation about wealth redistribution in China as well. And in Europe right now, that's a problem for both, 1, the miners, and 2, the luxury players, which make up a decent chunk of some of these equity markets.
Step by step, Xi Jinping seems to be really making moves on his agenda. And frankly, he does not seem to care about the slowdown that results. Yeah. This is a game changer for markets, and we're seeing that across the board.
Might not be as sexy as saying Fed taper on, taper off, Tom, but when you look at the moves in the equity market this morning in Europe, John, that's what's going on.
Is that sexy?
We're having a conversation on wealth. We're having a conversation on wealth redistribution
when Tom
at the Keene household.
Yeah,
I bet you are, Tom.
Yeah, we are.
Let's shop in with Kering.
It's called back to school.
And LVMH. Got to buy the Apple iPads. Is that right?
That's in there. That's spanking new HBO Max.
How many?
Great on that puppy.
From New York.
How many?
This is Bloomberg. Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here's the price action this Thursday morning. Good morning. Futures are negative, softer, lower. We're down by about 0.6% on the S&P. We're negative 1.4% on the Russell. The Nasdaq off by 0.4%. So many things going on this morning that we need to work through. A ton of contradictions as well. Here's one for you. Can you have the Fed tapering if we're also worried about a slowdown globally? Can you get one with the other? Does the latter make sense with the former? We need to talk about that. In the bond market right now, 2s, 10s and 30s, yields shaping up as follows, 122.83. Yields come in 3 basis points on 10s, on 30s down 4 to 185.68. That's a flatter curve. It's a bull flattener. It's led by the long end. That's the story in the United States right now, but I think we do need to spend a bit more time talking about the story globally. This has been building for a while. Switch at the board and finish on this. We've seen the move in the airlines. We've seen the move in the energy players. We've seen a move in crude. We've had 6 days of this now, Tom, down to 63.18. We're off by 3.5%. On copper, we're down 3.2%. That's copper futures. I hate that. You love that. We did it for you, Tom.
At the LME, 8,776 at the LME, John.
I appreciate it. I do this for you, and you do that for me. That's a partnership. You know. It's love. It's beautiful. China, that's what we need to be talking about, Tom. China. Every growth scare, pretty much every growth scare for the past 5 years has been born in China. And when China starts talking about restrictions, slower growth, and wealth redistribution, who does that hit first? Outside of China, EM, it's Europe. Look at the CAC 40 this morning. Look at the miners. Look at the miners in London. Look at the luxury players in France, in Paris. That's what's getting absolutely hammered. Does that sound like that's a story about Fed tapering, Tom?
No,
or a story about China?
I strongly agree, John. The idea that the Fed, the Fed analysis here has become secondary. As Goldman Sachs in their first sentence starts with the Delta variant. It's a different discussion now, John, than 10 days ago.
And Tom, you're right to bring up the Goldman call, because the Goldman call, I'll summarise it as follows: a downgrade for Q3, an upgrade to Q4 into 2022, largely because they're pushing this out. They think the give back will be in the later quarters and that ultimately we get through this. But the downgrade, to your point, Tom, wasn't on the Fed. The downgrade was on Delta. And that full service sector recovery we've been waiting for, ultimately delayed.
I'll give you the Q4, and this goes to our guest we're going to bring in right now. Very clearly, Goldman looks for a slowdown into the end of 22 as they use the dreaded D word, deceleration. Right now, to continue this discussion, to advance it within the stew out there, Andrew Slemon joins us with Morgan Stanley. Thrilled to have him on with decades of perspective. I guess it's an August volatility, Andrew. You and I have seen this before. Every story is different. Every August is different. Ben Laidler at eToro writes a scathing note to the bears this morning saying you're wrong. He said margins are there and they're so good. He says the weighting in technology stocks will actually increase in the coming years. Can you look out past this gloom and see better margins and better tech increase?
Wow, that's a loaded question. So, yeah, I mean, I think it's quite likely that these mega cap tech stocks reported great numbers. I don't think they're as expensive the way they were, in the year 2000. So I could see their valuations continuing to move higher. Earnings have been better than what people expected. So I think they could continue to move up. I think what we're seeing, I totally agree with what Jonathan said. This little summer swoon is not about tapering. It is about China.
So do you want to buy into the cyclicals move that we're seeing? The gap low you're seeing take place in Europe, the more energy parts of the market, the energy sensitive parts of this market as well, Andrew?
Yeah, I mean, look, I think it's early. The market's down 2%. Could we get a 5%? I don't think it's going to be more substantial than that, and I can tell you why. But I think you want to prepare for stronger growth going into the fourth quarter. You want to prepare for rates. Rates always kind of are weak at this time of the year. I think you want to prepare, get positioned for those areas that have already sold off in anticipation of this summer swoon, which were the financials, the reopening stocks. I think those will come back, but I think it's still early for that. I'd slowly leg into more of these positions over the next couple of weeks.
Andrew, what would tell you that you were wrong? How would you know?
I think if rates went to 1%, I mean, if rates really got hit, my basic view is that, look, the rates peaked in April. They've been dropping since April. They seem to have put in a floor, and that gives me confidence that the markets already anticipated this slowdown. And so as an equity investor, I got to get in front of the next move, and I think it's higher. But if rates were to really drop to 1% or below, it would challenge that thesis for sure.
Andrew, this is an interesting conundrum that I've been thinking about a lot. In the recent past, low rates were an excuse to go buy stocks. There was no alternative. And now you're saying if we get rates that go lower, that will be bad for stocks. What is the tipping point at which low rates are bad for stocks rather than good?
Well, I think what Jonathan was asking, that's a great question. I think Jonathan was asking my thesis of buying, kind of the cyclical financials reopening. If rates were to drop lower, those stocks would not, the market would suffer because I think it's a real growth slowdown. I think it would challenge people's earnings estimates, but it would certainly, those stocks would underperform the kind of the growthier names. So I think what's underpinned the market this year is simply that earnings have been stronger than what people expected. And if rates come down, I think that's a growth scare, and then suddenly that thesis is no longer prevalent. I mean, the reality is earnings estimates for this year and next have been revised higher than the stock market is up this year. So Wall Street is classically behind the recovery. And so I think if, again, a growth scare would suddenly reverse that, and that's why I think it would cause the market to run out of steam. I don't think 1.5% would challenge equity valuations because right now roughly half the S&P yields higher than the 10-year. That's a very unusual situation.
Meanwhile, today, one of the biggest stories, in my opinion, that's perhaps a little below the radar is that Toyota Motor came out and said that in September, their production would fall by 40% because of chip shortages. Just one of the supply chain disruptions that we have seen continue for longer than people had previously expected. Do you think that equity investors have adequately priced in some of these disruptions and the likelihood that they could potentially continue for substantially longer than people originally thought?
Yeah, I mean, look, so look, I think as long as it's not a demand-driven slowdown, then investors will look through a chip shortage because that's a supply issue. It's the demand side. If suddenly they said, well, there's not as much demand for our cars, I think that's what would cause a much more weakness. I think if it's chip shortage, the market will look through that. I just don't see it. So. Look, I don't want to sound, it's August. I've been raising cash. We've gotten cash into our funds. I've been sitting on that cash, waiting. But I really want to reiterate the key difference between last summer. We had a 9% correction in August last summer and this summer is that last year at this time, you rewind the clock to August 2020. All through the summer, we were getting calls from investors, from advisors saying, my clients think this rally is all, kind of hokum. We're going to have a COVID re-outbreak in the fall, and they want to cash out and get out. And can you keep people from cashing out? This summer, the call that we're getting is, when is a pullback coming? I have too much cash on the sidelines. So it tells me that it will keep the correction, from, really getting out of hand. And that's why I don't think we're good at a 9-10% correction like we had last summer.
In the CFA curricula, Andrew, there's a famous slim and buy on the dip theory. Where's the buy on the dip theory right now? Is it September? What is the single mechanism you have for stepping in, given the wall of liquidity that's out there?
Yeah, I think you got to watch rates, and as long as the 10-year rates don't really fall off a cliff, it tells me this is a kind of classic August situation. So when we get down 5%, we're going to start to put that cash to work. But again, it's a little early, so be patient.
Andrew, I'll try and be patient. I'll try my best. Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. Andrew, thank you. Look, to make it really simple, Tom, is it noise or is it news, and does it get reversed? And when you listen to The Economist, and we'll catch up with Neil Dutter of Renaissance Macro a little bit later this morning when we get jobless claims at 8:30 Eastern, any weakness in this quarter he thinks will be replaced by a stronger Q4 and a stronger year next year than anticipated because of that. Anything we take away from Q3, Tom, there is a belief it gets given back in Q4 and beyond.
So what do you do if your timeline's 1 year, if short term's 1 year out? I mean, not everybody's Doug Cass.
I agree.
Day trading the Yankees.
So not my view. Andrew just said it. Andrew's view over at Morgan Stanley, he wants to buy into the cyclical weakness that you're seeing on the screen right now, Tom. The cyclical weakness that's been born out of what is taking place in China, born out of the restrictions coming about because of the Delta variant surging, not just in China, but in Europe to some degree as well. Some people want to buy that weakness, Tom.
You want a 4-digit answer to Andrew's theory on the 10-year yield,
I would
John?
love that, TK.
1.1564 is 2 standard deviations lower yield on the 10-year yield. We're nowhere near that at a 122.
Right now, 122.50, Lisa. Yields are in by about 3 basis points.
But not to a 114.
Sure. They're not at that point, which triggers a concern for Andrew. However, he did say supply-side constraints aren't as much of a problem as demand-side. And one of the key issues I'm watching right now is, when do supply-side constraints become a demand-side issue? And we saw that with the consumer confidence. In other words, when prices start to go up because you just have these kinks in the supply chains, this actually reduces people's willingness to go out and buy. And it's a serious concern at this point.
Agreed. We're down 28 on the S&P. Let's call it 29. We're negative 0.6 on the S&P 500. We have to talk about this pandemic with Jennifer Nuzzo, the Johns Hopkins Center for Health Security Senior Scholar. We'll do that next from New York City this Thursday morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. In New York, futures are lower. This is Bloomberg.
With the First Word News, I'm Laura Wright. The International Monetary Fund said that the new government in Afghanistan is cut off from using reserve assets. That comes just days before the nation was set to receive $500 million, and it deprives the Taliban of key resources. The IMF says Afghanistan can't use the money because the new regime lacks international recognition. In Haiti, the death toll from that earthquake last weekend has risen to almost 2,200. Meanwhile, tensions have been rising over the slow pace of aid reaching victims. They've complained of inadequate food and material needed to temporarily repair damaged homes. There are more than 10,000 firefighters battling wildfires in California, but that isn't enough, and the state is having a hard time finding more wildfires as they rage across the western US and Canada. 12 major wildfires are now burning in California. In China, regulators have issued the harshest warning to the struggling Evergrande conglomerate. They demanded the company resolve its debt risks to ensure the health of property and financial markets. Evergrande's problems have led to sensitivity in China's credit market, which is leading to a pullback in home building. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
The time to lay out a plan for COVID-19 boosters is now. Recent data makes clear that protection against mild and moderate disease has decreased over time. This is likely due to both waning immunity and the strength of the widespread Delta variant.
That was Dr. Vivek Murthy, the U.S. Surgeon General from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market this Thursday morning shaping up as follows. We're negative. We're down 33 on the S&P. We're negative 0.8%. It's a classic risk-off setup here with a bond market bid, a dollar stronger, and a commodity complex that's a whole lot softer. Yields are lower by 3 or 4 basis points on 10s to 122.33. Euro dollar back with a 116 handle. A negative there by a little more than a tenth of 1% at 116.93, Tom. And in the commodity market, just about holding on to 63 here on WTI. We're down by 3.73% to $63 and about 2 cents.
On radio and television this morning, we'll do more data checks, keep you abreast. The VIX, 17.18 out to 23.81. That does get my attention. 30 is sweat. We're not there to sweat, but nevertheless well on our way, 23.81 on the VIX. This is an important conversation because Jennifer Nuzzo reads the research. Jennifer Nuzzo, the New York Times has a standout article on these silly plastic barriers that have invaded our lives. That includes Johns Hopkins University research, which say desk screens could actually give us an increased risk versus intelligent use of masks. Can you help us with the plastic that's engulfed us? I am hermetically sealed from Lisa and John. I haven't hugged Lisa in like 18 months.
That's not because of COVID.
I mean, help me, Jennifer.
I think Lisa needs help right now, Tom. Can you ask the doctor a better question?
I miss you guys so much. Jennifer, please, on the plastic screen, help.
Somebody reach over and hug Tom. He really needs it.
Go ahead.
No, I mean, listen, we don't have a lot of evidence for a lot of these things. I think intuitively there are probably some environments in which it makes sense. If, for instance, toll booth operators, people who have a lot of exposure with the public, putting another barrier between those people and the people they're serving, I think makes a lot of sense. But when you see people sitting at a desk and they have like a 3-foot, plexiglass between them, it's not clear what that does, if anything, and it sounds like it could potentially cause harm. The bottom line is probably not going to be as protective as a mask, although, we always try to layer these interventions. But, I think the most egregious example of the plastic was at one of the vice presidential debate, those tiny little things that separated the vice presidential candidates. Not going to do much.
Help me with then the need to get vaccinated. What does the last 48 hours show you within all your reading and research about the getting vaccinated?
That has not changed. If we do anything to put ourselves back to normal, to go back to our lives, it is to get vaccinated. There is nothing new in the data that suggests otherwise. Heard a lot of news yesterday about the potential need for a third dose. I will tell you, most people, including myself, think that the data aren't quite there to suggest that most people need it. There are clearly some small groups of people that absolutely need extra help, and that's the immunocompromised, and they're already able to access a third dose. But as far as people broadly, we're not yet convinced that that's happened. The bottom line is the vaccines are still doing exactly what they need them to do. They prevent us from getting ill enough to get in the hospital, which again, if this virus couldn't do it, we'd never hear of it.
Dr. Nuzzo, then when do we stop caring whether we get infected? Because right now, I'll tell you, I'll be honest, as a vaccinated individual who has a child at home, and I sound like a broken record, who is not vaccinated, I care as much about getting infected as I do about getting very sick, just simply because this will affect the people who I care about. So when does that change?
Sure. So I think that's exactly a potential off-ramp for caring about getting infected. I have also unvaccinated kids at home because they're too young. And hopefully when vaccines become available for them, that'll lessen those worries. But getting a third dose doesn't necessarily prevent you from getting infected in the first place. So that's unfortunately not going to ease those worries for you.
Dr. Nuzzo, there have been reports about new antibody therapies coming out of China that have actually been somewhat promising. How much does that potentially provide a game changer here where we can actually combat this and treat it more like a regular illness?
I think that's, one of the missing areas that we need more progress on is treatments because, there will be still some breakthrough infections, but also we know we have a lot of people who are not vaccinated and are going to need treatment. So that is, I think, an important area of research. We have some things now, but they're not very scalable. You still have the monoclonal antibodies you hear about. You have to go to a center and basically be hooked up to an IV. And so it's very hard to deliver that at scale, particularly given the number of cases that we have. If we could give somebody a pill and treat them, potentially even at home like we do for influenza, I think that would have an enormous contribution to lessening our worries about this virus.
Jennifer, New York City restaurants, and I'm sure other restaurants that our listeners and viewers are familiar with, they're in an uproar about paper vaccine inspection to get into their restaurant. When do we get away from the silliness of the 1850s? When do we get away from a paper document that's clearly instantly forgeable?
Yeah, well, I think that's a real problem. People can forge it. Unfortunately, the apps are not potentially better than that. I think there was a story about one of the apps being used in New York where you could just upload any photo and get a green check, and then it's on the bouncer at a club to scrutinize whether you got your 2 Pfizer doses on time. I think there are people who are pushing for a more verified vaccine record. Of course, that raises all sorts of concerns and potentially concerns among the people who have not yet gotten vaccinated. And we absolutely don't want to turn those folks off. But I think, we're seeing right now the challenges of the immunization records that we have. They're easily forgeable. In my view, people who are determined to not comply will find a way not to. People are very crafty. And so I tend to focus on changing hearts and minds and make sure we convince people to get vaccinated.
Doctor, thank you. Appreciate your time and perspective as always. Dr. Jennifer Nuzzo of the Johns Hopkins Center for Health Security. Tom, I think we also need to talk to mental health experts as well about the damage that's being done to society more broadly. And Lisa mentioned the children. Indulge me for a moment and allow me to talk about dear baby Charlie, my nephew, my godson. He went to the park the other day. He's 2 years old. He's 2 years old in just a couple of weeks. He went to the park, said hi to another 2-year-old child, touched the child on the arm, and the other kid ran away to his mum because baby Charlie had touched him on the arm because he'd been told at nursery that you can't hug each other, you can't hold hands, and you can't touch each other's arms. Tom, that's what we're doing to children around the world.
We're all dealing with it daily. We hear it, folks. Of course, we're talking to our guests all the time, off the mic, off the camera. We got a huge network of people here from all walks of life. And John, I'm hearing it 24/7 from everybody. And guess what, John? It's honest. I had to buy school clothes yesterday, uniforms and all that stuff. We're there. School, even for people starting in September.
But TK, I think the point I'm trying to make is that we're often having a very narrow conversation about the pandemic.
True. Yes.
And we're not having a broader conversation about a broader health crisis that's taking place.
Lisa's living it every day.
And the consequences of which, Lisa, we'll be living with for a long, long time.
Yeah. No, honestly, this is something a lot of people are going to be studying. If either of you do need a hug, it's fine.
You give
I'm vaccinated.
We're medically sealed.
I don't know what's going on.
Yeah.
Did you fall out?
I'm just trying to get everybody back on one desk.
Okay. From New York,
that's how?
This is Bloomberg.
When the economy's in trouble, you use your fiscal cannon to deal with that challenge. We're now in an ambiguous moment.
The markets are kind of hinting that the Fed may be making a mistake by moving too early on the taper.
The biggest driver, I think, of growth slowing is the fear of restrictions from the Delta variant.
When it is your hard-earned money as opposed to tax dollars, it takes a bigger hit to that mental outlook.
There's a ton of cash on consumers' balance sheet and corporate balance sheets. That eventually needs to go somewhere.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
If in doubt, blame the Fed. From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down 32 on the S&P. We're negative 0.75%. Tom Keene, if in doubt, blame the Fed. And once again this morning, that's what many people are doing.
Well, the Fed's always in the crosshairs, but it's much more than that. And I'm going to go to the beginning of the Goldman Sachs Markdown yesterday. The first sentence, they mentioned Delta variant. This isn't about economics, John. It's about the fourth story of this pandemic.
I couldn't agree more, Tom. The title of Goldman's downgrade was not related to Fed tapering. It was not related to an increase of interest rates on the horizon. It was a larger Delta variant impact on GDP and inflation. They downgrade Q3, but they upgrade Q4. And I think that's the bet, Tom, that we need to discuss. Is it something you lean into? Is this weakness something you buy?
Well, we heard that from Anders Slayman. We've got a lot of other people coming up as well on that. Ben Laidler, hugely bullish. Even Doug Cass nibbles today within the drawdown that we've seen. John, what I wonder is at Jackson Hole, should they rip up the script? And on the lawn with those lovely white tents for the Saturday lunch, should the head of the CDC speak to the economists?
I imagine they're going to be talking about that themselves, aren't they, Tom? Because as Tom mentions, this is as much about the pandemic as it is about anything else. And it's as much about China as it is about the Federal Reserve.
Which raises a question about that fourth quarter projection from Goldman Sachs, which is basically this idea that we can get production back online by the fourth quarter. Can we? I mean, how do we have that certainty? Can we hire enough workers to do that? What's the situation over in China? And what's the tolerance level for each case of COVID that gets diagnosed?
The ultimate bias, though, Lisa, and I don't think this has changed, is that it's recovery delayed and not recovery derailed. And that's been the bias now, Tom, since last summer. We've been talking about Q3 2020, Q4 2020, then it was 21. And now it's the back half of 21, and now we're talking increasingly about early 22. It's recovery delayed and not derailed, and that's still the bias right now.
And within the shock of Afghanistan and the other set of shocks we have, John, it's August where we recalibrate, not so much, folks, for Q3, Q4. And, John, I'm going to go back to the Goldman note because everyone's doing this, including Jan Hatzius. They're trying to guesstimate their 2022, and boy, is it a mixed set of opinions.
Yep, and futures right now, Tom, we're negative. We're down 0.7% on the S&P. Let's whip through the price action for you. Get you all up to speed. Yields are in 3 basis points to 122.50. It's that classic risk-off setup, the risk aversion bleeding through the commodity market. 62.97. It's a break of 63 on WTI. We're down for a 6th straight session and negative 3.8%. And Lisa, euro dollar with a 116 handle. We're negative there a little more than 1/10 of 1%. 116.94.
Yeah, that dollar strength really bleeding through all of the G10 complex. I was struck by what you said, John, this idea of recovery delayed, not derailed. When do we change that idea? When does the delay have ramifications that last much longer? 8:30 a.m., we get U.S. initial jobless claims and continuing claims. Do we start to see an unexpected increase in firings as a result of some of the shutdowns and as a result of some of the supply chain disruptions? And I wonder about that in light of exactly what you said. Services account for a significant portion of this economy. They still have not fully recovered. recovered. 9:45 a.m. we get U.S. Langer consumer comfort for the month of August. How much are we seeing consumer comfort affected by the increase in Delta variants? And then at 10 a.m. we also get the U.S. July leading index, which will give some sense of this. But John, I really do feel like that is a question. How long can a delay occur in the recovery before it has a longer lasting scar? And frankly, I have not seen any kind of projection that gives any kind of clarity to that.
Well, let's get straight to it, Lisa. Thank you. Stuart Kaiser joins us now, UBS Securities Equity Derivatives Research Head. Stuart, let's start there. Is it really recovery delayed and not recovery derailed?
I think we better hope so, Jonathan. That's certainly how the market's priced. Even though we're off 3 days in a row here, we're still kind of near all-time highs. I would say our consumer survey work, which we do on a weekly basis, I think points to that in the sense that those consumers still think the employment outlook is very strong, but their views on returning to work have declined substantially. So I think the consumer is still seeing a strong economy. They just are a little bit less excited to participate in it, because of the Delta variant and other things. And I guess the question there is one of persistence. How long will it take them, to be convinced to get back fully engaged? Mm-hmm. And to your point, that's the ultimate arbiter of how the economy looks, call it, 2 to 4 quarters from now.
Stuart, what are the derivatives say, and particularly what do they say about catharsis? We've had a drawdown of 2%, let's say. We're nowhere near a correction. I'm going to suggest there's no true catharsis out there. What does the math say about it right now?
I think the equity derivative setup has been pretty similar for the last few months, which is, 3 to 6 months out, there's a lot of risk priced in, both in the level of volatility and the cost to protect your portfolio. That's been the case, and we expect that to be the case. If you look at the shorter dated stuff, a similar story. Vols have come up, but if you look at how low realized volatility has been for the last couple of weeks, the level of the VIX, for instance, would not be justified by the level of realized vol. So, the market is a little bit on edge, but I would say we're not kind of at that, kind of run for the hills mentality quite yet.
When it comes to the bullish sentiment, how overly confident are people, though? I mean, I hear that people are trying to buy some protection in order to hedge the downside surprise. But do you get the sense that there is an increasingly bullish feeling that no matter what happens, people are going to come in and buy the dip?
Yeah, I think we are still in the buy the dip mentality, I would say, at the index level. It's below the index level where things have been a little more wonky, in terms of, am I willing to buy that reopening trade? Am I willing to buy the casinos and the airlines and small cap stocks and things of that nature? So, S&P sends you one message, and the below the surface stuff, can send you a slightly different message. I think by and large, people still do believe in the reopening, and they, I think, are of the view that the Delta variant is going to be, this too shall pass, type situation. But, 3 days down in a row for the index will definitely get people's attention. But, my view is, we're probably still, most clients we speak to, I think, are still generally in the buy the dip mentality and are probably looking for opportunities to re-engage with those reopening trades when they get to a level they're comfortable with.
Stu, just getting some headlines from the President of the United States. Let me jump in and just read out a few of them. This was in an interview with ABC. Some of the headlines as follows. The president saying no one anticipated Afghan troops would give up. There was no consensus in the intelligence. Advisors were divided on the withdrawal from the country, from Afghanistan. No one warned him to keep 2,500 troops in Afghanistan. Would have withdrawn troops even without the former president's deal, President Trump's deal, Tom. The president going on to say there would have been no good time to leave. Just some additional headlines from the President of the United States there in that interview conducted with the American broadcaster ABC.
The best summary, folks, to bring you up to those headlines is James Stavridis in Time Magazine, the former NATO commander. He will speak to Surveillance today. John, there's going to be all sorts of opinions and second guessing on this. What is the president going to do forward for Afghanistan, for the migrants out of Afghanistan, and to support the world in this debacle? That's the real question.
We'll get the forward look, Tom, down in Washington in about 10 minutes' time. Stu, I want to come to you on the market question. Tom, myself, Lisa, we've been having this conversation now for the last several days through much of this week. Does the international problem overwhelm the domestic policy goals? Infrastructure is a conversation we've hardly had this week. Do you have a take on that, a position on that at the moment, Stu?
I mean, I think the international growth risks are pretty evident in the rates market, over the last couple of months, right? Which is, Delta, I think, is viewed as more of a global risk to growth than a U.S. growth risk at this point. And I think that's forced central banks and governments globally to behave, quote unquote, a little more dovishly. And I think that's one of the contributors to getting U.S. real and nominal yields down to the levels they are. Is that enough to kind of overwhelm the domestic stimulus for U.S. markets? I would say not yet, but eventually that balance will shift if this is much more persistent. But I think we are definitely seeing global growth risk kind of spill over into the U.S., particularly through the rates market. But I think you're seeing it below the surface a little bit in equities as well.
And a lot of that's coming out of China at the moment, that's for sure. Stuart, thank you, sir. It's good to catch you up. Stuart Kaiser of UBS. Lisa, let's run through those headlines together. The President of the United States, in an interview with ABC, saying the following: there was no consensus in the intelligence. The intel community did not predict a quick Taliban takeover. There would have been no good time to leave. He said no one warned him to keep 2,500 troops in Afghanistan. Just responded to some of those questions about what exactly the intelligence told this White House, this administration.
Tom mentioned Admiral Stavridis, and he wrote a column in Bloomberg Opinion where he was talking about how the Afghanistani army was not equipped to fight the Taliban. And even though the U.S. set it up with all of these, high-quality equipment portals and all of these types of, U.S.-style army paraphernalia, that was not what they needed. They needed more guerrilla warfare. They needed more kind of local organization. And as a result, that anyone could have seen this coming, which was interesting given his role in the administration back in the old days.
So many of the questions that have been asked over the past week, and we've all been asking it on this question, is about how this White House, how this country left Afghanistan. This is the president's position on that, Tom. He does not think the withdrawal could have been handled better. That's the position of the President of the United States on the how question. He doesn't think it could have been handled better.
Okay, I'll go with that, John. And there's going to be a lot of navel gazing over the navel gazing. John is an American phrase.
I'm aware of it, Tom.
Idiomatic phrase.
I'm aware.
Maybe lost in translation.
We do it sometimes.
Yes, but John, what I find so important here is they invented a liberal democracy in Afghanistan, and now I guess they're going to export that liberal democracy out of Afghanistan. That's what we got to focus on right now.
So you mentioned the forward look, Tom. The president going on to say the United States will do all in its power to get Americans and allies out. And that's very much the forward look now, isn't it?
That's the forward look.
The next steps.
And, based on what I've seen in the zeitgeist, the French are leading the way with the French embassy still active in Kabul. Again, that's from secondary sources.
We'll get the view down in Washington. Up next on this program from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. The President of the United States to ABC. The United States will do all in its power to get Americans and allies out. From New York City, this is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden will keep U.S. troops in Afghanistan until all Americans are able to leave the country. That's even if it takes longer than his August 31st deadline to withdraw. The president also told ABC News that U.S. intelligence didn't foresee such a rapid advance by the Taliban and collapse of the Afghan military. A new study says that coronavirus vaccines are less effective against the Delta variant of the disease. That could lead to a push for booster shots for fully vaccinated people. The British study said that Pfizer and BioNTech's vaccine lost effectiveness in the first 90 days after full vaccination. In China, regulators have issued the harshest warning to the struggling Evergrande conglomerate. They demanded the company resolve its debt risks to ensure the health of property and financial markets. Evergrande has more than $300 billion in liabilities. Its fate has broader implications for the financial system and millions of homeowners. Goldman Sachs is expanding its presence in Europe. The firm has agreed to buy the asset management arm of Dutch insurer NN Group for about $1.9 billion. About three-quarters of the business's $355 billion in assets are backed by environmental, social, and governance criteria. Macy's is out with a sales forecast for the fiscal year that beats estimates. The department store chain also reinstated its quarterly dividend and authorized a $500 million stock buyback. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
We've got a little bit of a sell-off to get your teeth into from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here is the move lower on the S&P. Another day of it. We're negative 0.8% on the S&P, on the Nasdaq down by about 0.7%. Into the bond market, firmer. Yields lower. We're down 3 basis points. Treasuries 122.67 on 10s, Tom. 63 handle on WTI. Just $63 and negative 3.76%. Commodities, Tom, a bit of an issue this morning, and there's a lot going on. It is not just the Federal Reserve. It's China, it's Delta, take your pick. I think you used the words yesterday, it's the cross currents just coming together. And Tom, I think that's a decent description of where we're at.
Correlating out to a strong dollar, 93.35 on DXY. For those in the know, that's a big move. John, my pro tip is when it's like this, everybody's got emotion, everybody's doing this, that, and the other thing. You know what? Watch the VIX, just reprinting, I should say, 24.03, high 24.75. John, everybody's got an opinion of where the VIX sweats. 30 is my number.
Well, here's my view. I think that Chairman Powell speech next week gets a little bit more interesting, Tom. And I imagine if he could schedule the date himself and reschedule Jackson Hole, it might be on September 4th after the jobs report on September 3rd. That might make a little bit more sense at this point.
Well, maybe, but I'm guessing he's saying, everybody calm down and let's start rewriting the Jackson Hole speech.
Oh, you think a rewrite?
On Tuesday. Oh, yeah, it's going to be a rewrite.
I think some people have jokingly said we've had about 10 of those, Tom, over the last month.
No, I think they're going to go into major triage here to say the right thing out in Wyoming.
Or just
Lisa disagrees.
Well, I think that their goal is going to avoid saying anything. They're going to be talking about income inequality and things that are not necessarily going to play into their strategy because they just don't know right now.
You think a nothing speech next week?
I think that's the goal.
Can you get a refund on your flights?
Where are we going? I was going to say.
It will be beautiful.
Oh wow! That was your pitch. That was your pitch to management.
No, look, I think it could be. Look, I think it could be interesting, and let's get to our guest. But I will say,
Lisa wants to run now.
My point is they don't want to say anything that they might have to reverse in just a couple of weeks when we get more data in such a quickly moving situation.
I love that pitch.
Second pro tip of the block is Jack Fitzpatrick knows at the Pioneer Grill at Jackson Hole, the big decision is do you have the hangover breakfast or the cowboy grill breakfast? I mean, that's the way it goes. Right now, Jack Fitzpatrick on the serious nature of Washington on a very serious Thursday. Jack, just simply, what is the president's to-do list today? Not so much the agenda, but what's he saying we got to get done today?
Today and in the very near future, they're still in the process of adding that 6,000 increase of troops back into Afghanistan to try to essentially work with the Taliban to continue getting Americans and other Afghans at risk out of the country. It is notable that yesterday, Mark Milley, the chairman of the Joint Chiefs of Staff, said that this isn't something the U.S. can do, just essentially gaining ground in Afghanistan. They're reliant on the Taliban's cooperation there.
Herat is 500 miles west of Kabul. Okay, great. How do we get X number of Americans in Herat to Kabul to get out?
With the cooperation of the Taliban and assuring them, apparently, that even though the U.S. is saying troops could stay past August 31st, we're more or less still abiding by the agreements that were set in place a while back and in the process of leaving and taking a very limited steps toward getting Americans and a limited number of other people out. It's difficult. It's something the U.S. military can't do single-handedly. It's more, according to Mark Milley, a sort of a political operation and a political negotiation with the Taliban. And it's sort of a shaky situation because of that. It's not something the U.S. military can go enforce on their own terms at this point.
Jack, I want to clarify a point. When President Biden comes out and says that it couldn't have been handled better, I do wonder about the processing, the paperwork for some of the workers on the ground in Afghanistan. They were working for months on trying to get people here, and they said that some of the paperwork got backed up. Can you give us a sense of what happened and how they're going to expedite that in order to bring more people over in a more expedited fashion?
Yeah, that comment almost seems a bit self-contradictory when you look at the fact that the president also said they didn't really have intelligence indicating this is how everything would go in Afghanistan, and that even Kabul would be taken over by the Taliban so quickly. The process on some of these special immigrant visas was started ahead of time. There was some preparation. They even worked with Congress to get about $1 billion to expedite that ahead of time. But the conversation around that was not in the context of everything's going to fall apart immediately in the month of August. So there's clearly work still left to be done after the point at which the U.S. was supposed to be really in the process of drawing out of Afghanistan. Right. So it does not appear to really be true that this is the inevitable way that it was going to go. There were some steps taken ahead of time on visas to get people out, but the context of those conversations and what they did ahead of time was not on the same timeline.
Yeah.
That we're
well, Jack, this is important, especially as we talk about the broader labor economy, this idea that there seems to be a shortage of workers in a number of different areas, spotlighting the immigration issue. Are you seeing the Biden administration take a more open approach to immigration despite the COVID pandemic that's ongoing in order to stave that off and in order to provide a humanitarian need to places like Afghanistan?
You know, politically, I think you can see why the Biden administration may have been hesitant to outwardly call for some major push in migrants coming here because of the debate over immigration and the natural pushback they get from Republicans. But really, the kind of numbers we're talking about from Afghanistan at this point are in the thousands. It's not a very high number of thousands. We still don't have specifics on how many refugees, but in the context of the broader immigration debate, in comparison to work visas for people coming across the U.S.-Mexico border, it's not a huge number, and this is more a political debate or just a debate about human rights rather than something that would make a really significant dent in immigration in the terms that we usually have it.
Hey, Jack, appreciate the hard work you're putting in at the moment. We really do. Thanks for getting up early and joining us. Jack Fitzpatrick there of Bloomberg Government. Anne-Marie's thinking, why didn't you thank me? I woke up an hour early. Thank you, Anne-Marie, for coming on with us as well.
Yeah.
You know, Anne-Marie, you know what she gets like, Tom? Get those emails from down in D.C. of complaining. Futures down 37 on the S&P, down 0.8%. Yields are in 3 basis points on a 10-year to 122.83. And Tom, copper, crude, take your pick in the commodity market.
Copper, LME down 3 standard deviations. John, I must admit that gets my attention.
Yep, copper down by 2.9%. From New York City for our audience worldwide. Bit of risk aversion this Thursday morning. Good morning to you all. We're down 36 on the S&P. We're negative 0.8%. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Heard on radio, seen on TV. This is Bloomberg Surveillance. Live from New York City for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg Surveillance. Good morning. Here is the Thursday morning price action. We're negative 0.8% on the S&P. We're down 0.6 on the Nasdaq and off by about 1.61% on the Russell. Here's the cheat guide. Equities lower as we start to fear the Fed taper. Headline. Here's the nuance. Switch up the board and get to what's happening in Europe. The FTSE 100 getting absolutely hammered right now, negative 2%. The CAC 40 over in Paris, France, negative 2.5%. And Tom, here are some movers for you, individual ones. Anglo, the miner, down 12 percentage points. Kering, the luxury goods maker, down by 7.5%. Yeah. Here is the nuance, the detail. There is a massive China factor in this story. It's been weighing on commodities for quite a while in terms of the growth fears because of the additional restrictions. And then the additional story today in the mix overnight, Tom, a real conversation about wealth redistribution in China. Property taxes, those kinds of things, the rich giving back. And what does that mean for the luxury players? It means Kering, LVMH in Paris getting hammered. What does it mean for the miners, the growth fears? It means Anglo, Antofagasta with their own problems getting hammered. Tom, it's more than just the Federal Reserve and a very simplistic taper headline.
In China, I look at the monetary dynamics, John, and how they fold into their debt. We've seen headlines on the Bloomberg today on that. You've got to believe it's an eventful weekend. If I have to look, John, at one timeline, it would be Sunday evening New York time is when they make those announcements.
So let's get to those two things and combine them, Tom. Get to the bond market. Switch up the board. Look at 2s, 10s and 30s. Your yield right now, 122.83. Your 30-year comes in 4 basis points to 185.81.
2%.
That curve is flatter, Tom. 2% is well north of where we are right now on 10s at 122.83. And my question of this morning, Tom, there's a lot more than just tapering going on here. But if it's tapering you worry about together with China growth fears as well, can those two things happen? Can you have the former if you have the latter? Do you really think the Federal Reserve starts to remove accommodation in a market where there's increasing fears about growth?
They're going to look at the jobs report on September 3rd, and they're particularly going to look at the inflation dynamic, which is wage growth or lack thereof.
I'm so with you, Tom, because I think September 3rd, that jobs report is far more important than anything that's about to happen over the next week in Jackson Hole, Wyoming.
Yeah, absolutely.
But what are our views worth?
No, Romaine's views are worth more than
worth far more.
Yeah.
That's why we had limited time with him. So let's get to him. 122.83 on 10s. With your movers, here's Romain Bostic. Hey, Romain.
Hey, good morning, John. Well, you did a good job of summing up the macro picture, and it is that macro picture that is driving a lot of the individual movers this morning. J.P. Morgan and the rest of the bank stocks are lower here in the pre-market. We should point out the regional banks are even doing worse. The KRX, the KBW Regional Bank Index, down now for 5 straight days as of yesterday's close. If it is down for a 6th straight day, that's going to be the longest daily losing streak going back to February. A lot of concern not only about what folks are looking at there on the yield curve, but of course about the Delta variant and how that feeds into the broader economic picture. And of course, everyone still has their eye on what's going on over in China. Alibaba shares, ADRs, I should say, down again here in the U.S., down the most, down to the lowest levels, I should say, going back to October of 2019. And we should point out that their Hong Kong shares, which of course just listed back in November of 2019, actually today hit a record low here. Keep an eye, of course, on Robinhood. This was a big story after the bell last night. First earnings as a publicly traded company. And really the big question now is if all of your money is being made off of something that's effectively a joke, does the company itself become a joke? You're talking about a company that doubled revenue in the most recent quarter, but more than 40% of that revenue basically came from the selling of cryptocurrencies, and more specifically, 60% of that came from Dogecoin itself. The company guiding a little bit. Yes, Tom, it was Dogecoin was the big driver of that revenue gain. It did not actually drive any profitability, and that's the big concern here, is that once that type of hype fades down, what's left here for the company? It's still a behemoth of a company, 25 million active users there on that platform there, and a company that still sees profitability in the future, but at least in the short term, some of those headwinds that tailwinds that they got from the meme stocks, that does appear to be fading. Flip of the board real quick, there still is a chip crisis out there. Toyota warning about that today, suspending production. A lot of companies here in the U.S. are lower, including General Motors and Ford. Remember, Toyota was actually managing the chip shortage probably better than any other automaker, so the fact that it's now warning on this issue raises a lot of questions about what GM and Ford are facing. And two bright spots real quickly. NVIDIA, a beat and raise quarter, and Macy's, a beat and raise quarter. And more importantly, Macy's now confident enough to actually reinstate its dividend, 15 cents a share per quarter, plus a $500 million buyback.
Romain Bostic, thank you so much. On this stew, we go macro. We do that with George Goncalves with MUFG Securities America's head of U.S. macro strategy. George, I want you to fold the GDP guesstimates into the dynamics of the market. You are acclaimed at yield dynamics. How do you fold a movable feast of GDP guesses into that?
You don't, Tom. I mean, and that's really the bottom line. We've been really divorced from these fundamentals for, going on 5-10 years, and this is something that I think most rate forecasters have been kind of struggling with, is trying to go back to what does growth and inflation really mean for what should be captured within an interest rate forecast, and I think that's the way things go. I mean, the bond market trades more and more on price and on momentum. It trades almost like a commodity in many regards, where yield becomes like a second thought until yields get too low, and then people start saying, "Wait, why am I buying it? There's not enough carry."
George, Lisa brought up a quote yesterday from Bank of America that I think is really important. I was talking about it as well. Bank of America suggested we were at the threshold of a major bifurcation of scenarios. They could see yields go to north of 2% by the end of the year, south of 1% by the end of the year. Do you think things are that finely balanced right now?
I mean, maybe not that finely balanced, but I do think that there is a break potentially coming up soon, and that is definitely true. And I think you kind of in your intro kind of alluded to these things that, on the one hand, the Fed is not going to get boxed in. I mean, we saw from the RB and Z, if the Delta virus were to get worse, or if we were to get any sort of kind of slowdowns beyond what's being projected, or the concerns of like this kind of peak growth gets further entrenched, and that factors into a slower end of the year and into the early part of Q1, the Fed can just kind of always push back. That's what they'll always do. They're never going to pull forward tightening. They're always going to push it back. And of course, these global factors matter too. And so even if we were to handle the Delta virus better in the U.S., if the rest of the world either has more lockdowns, that's an issue. Plus this China growth dynamic, if that starts to really weigh on commodities and overall just kind of economic and financial conditions, the Fed's going to take that into account as well.
When you say the Fed won't get boxed in other words, they don't want to necessarily commit to tapering, there is an issue of harmful effects of their carrying on with their programs the way they are for a longer period of time, especially as we do see inflationary pressures. Yes, they're idiosyncratic with respect to supply chain issues, but also on the margin, if we do get a rebound, like Goldman Sachs thinks, it could be that much bigger if the Fed keeps pumping money into the financial system. How much are you concerned that the Fed is shrugging off some of these deleterious effects of their continuing of monetary stimulus at this point?
Oh, I'm concerned. I mean, as we all know, it's not what we want the Fed to do or we think the Fed should do. It's what they will do, right? So we're always trying to forecast that. I mean, I do think that they should be in the process of tapering, and maybe they've overstayed their QE welcome for quarters now potentially, and they maybe we should have been starting sooner. But that's not my opinion, not necessarily what they're going to do.
Well, but let's go with that. Then what's the negative consequence of that you're willing to bet on or that you're gaming out in terms of your market call?
Yeah, so right now, like the concern is, and we're seeing it manifest itself in the RRP, in the reverse repo program, and how there's too much liquidity. Even in the minutes yesterday, there was reference that potentially, as we head into a debt ceiling with all this liquidity, with the Fed not tapering yet, potentially, most likely, I don't think they're going to do it in September unless things really perfectly line up in terms of tapering announcement. And even if they do that, they're not going to start it in September. So there's going to be a lot of liquidity still in the system into this very acute period of excess liquidity. And so that causes an issue potentially for the money markets. So there's definitely signs that they need to be tapering and they need to get out of this QE business.
You've spent a long time with Japanese banks, George. The reason I bring that up is because you've got a lot of experience looking at the Japanese bond market. I want to understand from your perspective, because some people raise this question, and just because I'm asking it doesn't mean I believe it's going to happen. I think it's a question we need to be asking. Do you think we could replicate what we've seen take place in Japan over the last 20 years, which ultimately Europe took over in the last 10? Do you think that could happen in America?
So Europe is still struggling with believing that there's a Japanification going on within their bond market. But when you have negative rates and you have just low activity overall in Europe, I think Europe looks a lot more like Japan than the U.S. will, for the most part. But I think that we talk about always like these breaks in markets for the next quarter, but the real breaks is trying to understand the next 3 or 5 years if the U.S. can really get back into a growth trend that would prevent us from falling into like this Japan scenario.
George
And I would say no. I would say we're not there. It's not there yet.
I agree. MUFG Securities and Macros Head of U.S. Macro Strategy. Lisa, we're not there yet. It's not clear yet, but that question's being asked continuously.
Especially if the Fed keeps on buying treasuries. And you talked about this week, the idea that the U.S. Treasury Department is going to sell less debt going forward. So if the Fed starts to taper, they'd only be keeping their stimulus the same pace. If they keep it the same pace it is now, it's actually increasing stimulus by some measures.
Increasing stimulus.
At this moment.
Okay.
Well, I mean, honestly, they're increasing their footprint in the market. I'm just struggling also with this idea of other consequences socially if they continue with this. In other words, people who are wealthy continue to increase their wealth, and the people who are not in the market are not participating in this.
Lisa, preach. How many people come on and talk about that? The asset issue right now. If you own assets, fantastic. They've gone up markedly. If you don't, you're suffering. That's the argument that the central banks are contributing to wealth inequality, Tom. Now, for the Federal Reserve to do something about it, they have to realize they're a part of it. Do you think they do?
Yeah, I think they do. I think the wealth inequality issue is from a tradition of lifting up all boats behind clearly the haves doing better versus a whole nother discussion wrapped around Gini coefficients and the rest of it. John, it's going to be addressed at Jackson Hole. It's addressed in the market every day. But you know what? The basic theory is what people are going to worry about. And my answer is, what's the theory right now?
We'll address
I'm not
it
sure.
with Dan Alpert in just a moment, Tom, at the top of the hour. 19 minutes away. Westwood Capital founding managing partner.
Perfect.
Looking forward to that. We're down 31. We're negative 0.7% on the S&P 500. Yields come in 3 basis points on 10s to 122.67. Let's call it 122.83. A defensive posture this Thursday morning from New York City. This is Bloomberg.
With the First Word News, I'm Laura Wright. The International Monetary Fund said that the new government in Afghanistan is cut off from using fund reserve assets. That comes just days before the nation was set to receive $500 million, and it deprives the Taliban of key resources. The IMF says Afghanistan can't use the money because the new regime lacks international recognition. In Haiti, the death toll from that earthquake last weekend has risen to almost 2,200. Meanwhile, tensions have been rising over the slow pace of aid reaching victims. They've complained of inadequate food and material needed to temporarily repair damaged homes. There are more than 10,000 firefighters battling wildfires in California, but that isn't enough, and the state is having a hard time fighting more wildfires as they rage across the western US and Canada. 12 major wildfires are now burning in California. The rout in Chinese tech giants got worse today after the industry was hit with a new round of proposed regulations. Alibaba fell to a record low in Hong Kong. Tencent and Meituan were also lower. China is studying proposals to further ensure the rights of drivers who work for online companies. The government may also step up oversight of the use of the live streaming industry. Shares of Toyota fell today. The worsening chip shortage will force the world's #1 automaker to cut global production next month by 40%. Toyota had intended to build 900,000 vehicles in September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
It's going to be very difficult for the Fed because they want to project certainty, or they want to project calm, that we've got this figured out, where inflation is going to go. It's going to be transitory. The fact of the matter is they don't know, we don't know. Inflation is a very difficult thing to get your head around, and it's a very difficult thing to understand.
Always brilliant to catch up with Jim Bianco of Bianco Research, the president. Good to see him yesterday from New York City this morning. Good morning, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Here's the state of play this morning. Waking up to a softer market, negative 0.7% on the S&P, with yields lower 3 basis points to 122.83, with crude down for a 6th straight session to $63.31. And the why? There are many whys. This from Andrew Brenner of Nat Alliance, going on to say plunging global sentiment from the Delta variant, fears of efficacy from vaccines, GS cutting their third quarter GDP, the realization that the Fed is tapering, and more
Sachs
Chinese anti-capitalistic regulations, the Red Sox collapse. All of that stuff, Tom. Put it all together.
Put it all together.
That's what you got on the screen today.
John, it's a drawdown. Let's go to the math.
Major.
This you do, folks, on the WEIF screen. David Wilson showed me that years ago. I say SPX drawdown, negative 1.86%. On radio and television, the always handsome David Wilson. What do you got?
Well, it's kind of a corollary to what I talked about a couple of days ago. Back then, I looked at the Russell 1000 growth and value indexes and pointed out they basically have converged in terms of this year's performance, right? But then you do the same analysis with the Russell 2000 index, smaller companies, and you see there's no convergence at all. I mean, you're talking about quite the gap between the two. So you could argue it's sort of a great divide that we're seeing between these indexes. And, you know, there are a few reasons for it. One is that when you look at the Russell 2000 Growth Index, you see that healthcare is the biggest component. It also happens to be the only component of the Russell 2000 Growth Index that is down for the year. And, turn to technology, you see it's about half of the Russell 1000 Growth Index, and it's actually beating that benchmark this year. On the other hand, Russell 2000 tech is about 20%, and it's trailing.
So in your reading of the zeitgeist right now, what is the distinction, the interesting thing you see in the growth versus value debate? What makes you lean forward?
Well, it really comes down to, when you look at the Russell 2000, you got to ask yourself, is the gain that we're seeing in growth this year really just a matter of those big tech companies, the ones we always talk about, the Apples, the Microsofts, the Amazon.coms of the world.
It's just 12 stocks, whatever the number is, and everything else, right?
Well, it's kind of looking like that when you look at the growth part of the equation. Value, you can argue there's sort of a broader move going on. But, to see that kind of come around, it does kind of get your attention.
Lisa, save us. I have to remeasure the drawdown.
The drawdown curtains, find out some good ones. I will say that what you're talking about, Dave, is really highlighted by what Charles Retsky of Mizuho wrote this morning. The S&P 500 is now down just 1.77%, but the average stock is off by 9.4%. And basically, when you take a look under the surface, you can see that save for those big tech stocks, you're seeing much more pain and broader based. And I'm wondering what the conclusion is that you're hearing from people about what that means going forward.
Well, there's some concern about whether it's finally time to have a pullback here. Bear in mind, you have to go back to October to see the last time the S&P 500 had a 5% drawdown from a high. There's been this persistent strength. 49 records for the index this year. That's the concern is, because you've kind of seen, smaller companies, riskier companies kind of tail off to some extent, arguably going back to February. Well, that's, why there's just this concern about how sustainable the gains are that we're seeing here.
But Dave, we have seen a drawdown in specific stocks. And I think that's the point, the idea that we have not gotten a drawdown that's significant in the index level, but that is because of these big tech names. We are seeing it under the surface. Does that mean we may not see the broad-based drawdown? However, people view this already as that and are starting to go in and buy a dip that did happen just in specific stocks.
Right. There is certainly that potential here. People are seeing the signs of weakness. They're pointing to, a variety of indicators that, suggest that what we're seeing, say, in the S&P 500 isn't the whole story. And yeah, you can argue that, to some extent there has been, sort of the buying of the dips on a broad level, even though you really haven't seen much of anything come out of the S&P 500 on that score.
David, I'm punching up here, and folks, you can do this on the Bloomberg. Try it at home. You can punch up like 1998.
Yes.
You want to talk about a drawdown? What we saw, I'm doing it right now, folks, in real time. Come on, the drawdown right now of 1.86% is back to August 3rd. Distant, far back.
Right. It's not much. There's no question. But we haven't seen much, for 10 months running. So, you talk 1998. Of course, you had the collapse of long-term capital management. You had the Russian debt default. You had some issues that the market definitely had to get through back then. And, there are issues today, but they're not, delivering the kind of severity that you saw in the 90s.
Yeah, David Wilson, thank you so much. John, the drawdown from July to September, make it late August 1998, was 19.36%.
I love it when we're just having conversations with each other, but doing it with other people, Tom. Why do I feel like the last 5 minutes was just you trolling me? When I say drawdown, Tom, I'm not talking about a big move. I'm just talking about direction. Just direction. Just coming in a little bit. Does that help? We're down a little bit this morning, 0.9%.
It is. The drawdown's there, John, and we're going to see. I don't mean to make light of it. There's so much going on now, John. And again, I would bring it over almost a shock, as you mentioned, China earlier.
China is the issue right now, Lisa, particularly for Europe, and we're seeing Europe get hit pretty hard. hit pretty hard over in France as well.
Yeah, there have been drawdowns. That was my point, is actually that you're not wrong saying that when you look at specific sectors. I'm looking, for example, at energy stocks. They're down nearly 13% since the end of June. I mean, you are seeing specific sectors totally get hammered, and this is because of what we're seeing in China. It's being buoyed by the revenue drivers in the United States, big tech.
Look at these headlines, one after one. This from Andrew Brenner of NAT Alliance. I read them off about 5 minutes ago. I'll do it again. This is what's going on right now. It's just more than one thing. Plunging global sentiment from the Delta variant, fears of efficacy from vaccines, Goldman Sachs cutting their third quarter GDP estimates, realization the Fed is tapering, and more Chinese anti-capitalistic regulations. And we are talking about wealth redistribution in China as well. The luxury players front and center, Lisa.
Yeah, and this honestly is affecting and really throwing a crimp in the prospects for a lot of specific companies. I mean, if you're looking at the index level, it is being stabilized by these ballasts of cash flow. I mean, that is what we are seeing. And under the surface, there still is a lot of pain being priced in, which is fascinating given the sanguine nature of some of these price moves.
The equity market down 38 on the S&P. We're negative 0.9%. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your bond market, it looks defensive, doesn't it? Yields lower by 3 basis points to 122.50. Euro dollar negative 1/10% to about 117. And crude a whole lot softer. This is 6 days of this now on crude. We're negative again by 3.65% on WTI, $63 and about 7 cents. Heard on radio, seen on TV. This is Bloomberg Surveillance.
There's an unprecedented amount of liquidity everywhere. A lot of it seems to be kind of on the sidelines.
The biggest driver, I think, of growth slowing is the fear of restrictions from the Delta variant.
The consumer is still seeing a strong economy. They just are a little bit less excited to participate in it.
It's likely we return back to the growth levels that we saw at the end of 2019, early 2020. So prior to the pandemic.
Rates peaked in April, and that gives me confidence that the markets already anticipated this slowdown.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. A bear market, well, it's a simulcast on Bloomberg Radio and Bloomberg Television. John, we retest the lows of an hour and a half ago right now. Futures at negative 41, Dow futures negative 363.
The S&P 500 down 0.9%. The bond market bid yields lower in crude. Tom, we've had 6 days of it. Crude lower, negative. WTI 63.24. It's tapering. It's China. It's the Delta variant. It's take your pick. It's all coming together over the last couple of days,
What's your
Tom.
insight off the Bloomberg terminal right now, John?
Equities, Tom, lower in Europe. I want to talk about Europe a little bit more than I want to talk about the United States. China's talking about wealth redistribution. That's really hitting the luxury players over in Paris, France. The CAC 40's down by 2% and more. And my point there, Tom, is there is so much more going on than just the taper story at the Federal Reserve. There's a whole lot more going on, more specifically in China.
Well, in China, it's there, and it's been there. John, you've been great on this as we see some real GDP issues. Lisa Abramowitz, I'm going to give you a major shout-out. Not only the Toyota news today, and that stock down off supply, off supply issues. But Lisa, as we go to Dan Alpert in a moment, the supply dynamics now are really front and center.
The idea here that when you get the inventories that are being depleted by the high demand of goods, and you're getting it so that companies, corporations cannot import more because it is not there to be had. People are not able to get the ships over to other countries. This is causing inflationary pressures. This is causing consumer sentiment to take a hit lower. And then you also have this question of how quickly will we get this back online at a time when companies are really short of goods to sell.
John, bounce it, John, from Toyota back over to China. Ningbo, the shipping port there constrained. You know the shipping costs right now out of China, and that folds into China is the global thermometer here.
And Tom, it comes back, though, to the market bias. Delayed, not derailed. It is recovery delayed, not recovery derailed. And Neil Dutter of Renaissance Macro will join us in about 27 minutes' time, and he'll talk about that. The Goldman forecast, the absolute beating that Q3 forecast got, Tom, but it's followed up with a Q4 upgrade because many people believe anything you take away from Q3, you get back in Q4. That's the conversation we need to have about this economy.
I have trouble with the quarter-to-quarter parlor game, particularly given the Delta variant. John, we really have to say, away from the shock of Afghanistan, Delta variant is the new regressor in this equation.
And COVID elimination as a strategy, Tom, makes you so sensitive to one case, New Zealand, a handful of cases, China. And that's where the weakness is coming from at the moment. And to Lisa's point, both on the demand side, Tom, and on the supply side as well.
Swiss franc in, euro under a 117. A weaker euro finally gives way to a 116 handle. John mentioned oil. John, I'm just going to mention the VIX, 24.40. What do you see?
Euro, 116 handle. Dollar strength. Dollar index with a 93 handle. Tom, euro, dollar 116.97, down a little more than 0.1%. And equities, there's your pullback. Your drawdown. We're down by 0.9%. I'm winding you up. We're down 1% on the S&P. We're negative, Tom, about 42 points.
Maybe there, but it is a deceleration. And again, for those of you looking at this morning, we welcome all of you on radio and TV. And the S&P futures now giving way. We're not through the low, which was seen off the surveillance cursor at about 5:16 a.m. Daniel Elpert is not worried about 5:16 a.m. He has a longer view, and it is codified in his classic, The Age of Oversupply. It was one of the 2 or 3 prescient books of the financial crisis. The supply disruptions are tangible. Mr. Elpert joins us this morning. Daniel, in the middle of your book, you talk about bad policy, denial, and decline. Are you that gloomy now? Do we have denial and decline operating in 2021?
No, I think we actually have been fairly reactive to the facts on the ground, and our policy is actually rather progressive relative to where we were back then. But just look at where we are from the standpoint of the Fed's tapering. Contrast what you're seeing right now to what you were seeing in 2013. You have equities selling off. You have a bunch of media headlines that say that the equities are worried about tapering. And yet the bond market is demonstrating something completely different than what it did in 2013. It's rallying. And more importantly, you've got exactly what I think John was talking about just before. You've got things going on in China and Europe that are really setting a tone for the equity markets apart from any concern about tapering.
Yeah.
So this is a very, very different situation. Domestically, policy is actually moving in the right direction.
The optimist, Dan Elpert, and I'm going to lead here with a superb interview with David Stubbs of J.P. Morgan yesterday, I believe it was, and Ben Laidler's Morning Note. These guys say we're in a technological revolution. Can that overcome the gloom of this or the gloom of that?
Well, technology, unfortunately, tends to pass itself through to real productivity through the manufacturing process and goods producing process. We've sort of deluded ourselves for a couple of decades, thinking that these lovely devices we keep in our pockets and all of this prospects of AI in the future are going to provide some enormous productivity boost. They did during the internet revolution. We saw a huge jump in productivity, but that leveled out, starting in 2003. And since then, we haven't seen that boost simply because this country doesn't really produce a lot in terms of goods. So a lot of the improvements that we've seen in terms of productivity have migrated abroad. The ability of technology to be a real game changer really depends on finding avenues and channels for that technology to really add to domestic productivity. And some of the policy that we're talking about, especially in green energy, actually has the prospect of doing that.
Well, in the meantime, Dan, as you were saying, we don't really produce that many goods relative to the economic impulse of services in the United States. And this strikes me when John talks about whether we have a recovery delayed or derailed. I mean, if you have services still not back up to pre-pandemic levels at a time when goods purchases are ramping up dramatically way above that, I'm just wondering whether we can have simply a delayed recovery versus scarring that goes far deeper than people previously expected by the prolonged pandemic.
I'm gonna introduce just a slightly different take in that, are we actually experiencing a cyclical recovery? All my business cyclical focused colleagues are looking at this because there was a brief recession as a restart in a business cycle. I view the pandemic as something that is completely sui generis. It's something apart from a conventional cycle. We shut down the economy, we put it into a medically induced coma, and what we're doing right now is coming out of a huge amount of disruptions across the board: labor disruptions, supply chain disruptions, everything. But the question is, and I don't think this has been answered yet, is whether or not this is a real early stage cyclical recovery or just an extension of a long in the tooth recovery that extends all the way back to 2012 with the middle stages of the recovery from the Great Recession. So I don't think that book's been written yet. I think it's going to be very interesting to see. Clearly, we've got some major disruptions, though, that are coming out of the pandemic aspects of this, putting aside Delta variant, which is certainly a big issue. I'm not minimizing that. But we've got a big act that's coming to a close on September 6th. We've got 12 million people still in the labor force who are still receiving federally supplemented unemployment benefits. And those people are going to be back in the labor force at some point. It may take a month or two to show up. But that is going to be a major game changer going into Q4. So any estimates of what's going to happen at the end of the year, I think, need to be tempered by understanding that that's something that we've never really experienced before. That sort of major drop-off in support, that's the last of the major pandemic supports.
Dan, it's such a good final point. We needed to hear from you this morning, and I'm pleased we did. Dan Alpert there of Westwood Capital. Thank you, sir. We mentioned what's happening in Europe just briefly. Let's look at the luxury players just quickly. Hermes, Kering, LVMH. Kering's down more than 8%. LVMH is down by 5.6%. We've talked a little bit this morning about this high-level party meeting that took place in China, led by President Xi, who has called on high-income groups to give back to society more. It's weighing on the luxury players. Tom, here are the stats. A lot of reaction from the sell side. This was from UBS. Swatch has an estimated 50% exposure to Chinese consumers pre-COVID. Burberry around 40%. Richemont around 40%. Hermes around 35%. Prada, approximately 35%, Kering, 33%, LVMH, 31%. Those numbers coming out of UBS this morning. Tom, that just gives you an idea of what is happening here in Europe this morning, with a CAC 40 down by almost 3%, and those luxury players getting absolutely hammered because of this conversation in the world's second largest economy.
I completely take the point of the tourism issue and of the luxury China issue, John. I've actually sat, John, I know you're not going to believe this, I've sat in the Gucci store Florence.
I'm shocked.
And there were not one, but two good people from China, each holding 3 cell phones, one showing the photo of whatever they were looking at, one on the phone talking, and I don't even know what the third phone was doing. And the answer is there weren't one, there were 2 of them in the Gucci store. And so I walked out without making a purchase.
And Lisa, that's not happening because the travel isn't happening in the same way, point one. And that may not happen in the future, point 2, because there might be this push for wealth redistribution over in China.
Yeah, flaunting your wealth is going out of favor in a lot of places throughout the world.
It's going to be very interesting to see what happens there. Your equity market down 36. On the S&P, we are negative 0.8%. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Laura Wright. President Biden will keep U.S. troops in Afghanistan until all Americans are able to leave the country. That's even if it takes longer than his August 31st deadline to withdraw. The president also told ABC News that he doesn't think the withdrawal could have been handled better. Plus, he said the intelligence community did not predict the Taliban would take over Afghanistan so quickly. A new study says that coronavirus vaccines are less effective against the Delta variant of the disease. That could lead to a push for booster shots for fully vaccinated people. The British study said that the Pfizer and BioNTech's vaccine lost effectiveness in the first 90 days after full vaccination. In China, regulators had a tough warning for the struggling Evergrande Group. They told the conglomerate to resolve its debt problems and stop spreading untrue information. It was a rare public rebuke of the developer. Evergrande has more than $300 billion in liabilities. Its fate has broader implications for the financial system and millions of homeowners. Amazon reportedly would expand into an area where it has been traditionally a disruptor, bricks and mortar retail. According to Dow Jones, Amazon plans to open several large physical retail stores in the US. They're designed to extend the company's reach in clothing, household items, electronics, and other products. Macy's is out with a sales forecast for the fiscal year that beats estimates. The department store chain also reinstated its quarterly dividend and authorized a $500 million stock buyback. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
The chip shortage is also, which is driven by the capacity. Already the actions has been taken by our suppliers, and this will also go away. Whether this will go away in short term, I don't think so. Whether it will continue in long term, I don't think so, but it will continue in midterm.
They are the questions. That was Ashwani Gupta, the Nissan COO from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. It's a risk-off Thursday morning, that's for sure. We're negative 0.8% on the S&P. Your bond market's firmer, as it should be. On a morning like this morning, yields are down 2 basis points on a 10-year. In the FX market, we've been this way the last couple of hours. Euro-dollar slightly negative, down a little more than a tenth at 116.97. And crude down for a 6th straight session. We are negative 3.39% on WTI. Tom Keene, 63.24.
I'm going to call it a wait to the tape. Anyone looking for a recovery from 4 or 5 a.m. this morning, we don't see it at this time. Right now in China, the many Chinas, the many stories from China. We're thrilled Enda Curran could join from Hong Kong, our chief Asia economics correspondent. And there's a lot of things to talk about here. Let me go as quickly as I can. Elizabeth Economy, my book of the summer a number of summers ago, The Third Revolution. That's about President Xi. His revolution looks the same as every other revolution, which is a $21.6 billion bailout of a given company. Is it business as usual where the government will save the day?
Well, it does seem that way, actually, Tom, because there had been a lot of uncertainty, like you mentioned, about one of the big bad banks here, Horong. There was a feeling that perhaps there could be a restructuring or even a default. Well, the state has stepped in now. They will be recapitalizing Horong to the tune of about 7.7 billion. In fact, our colleagues out of Beijing are reporting. And that's been the big signal that China is there still, that there's still such a thing as too big to fail. And then tonight, of course, we had news that Evergrande, this big property company that has liabilities of about 50 billion, that was called in for stern talking to. So clearly they're going to get it going over next.
Well, they might step in some players, but not in others. And I'm saying this in a day when Alibaba is hitting a new low in Hong Kong. You're seeing Tencent sell off as they warn of further regulatory pressures. At what point do we look at a changed China that is emphasizing something more social and much less economic?
Well, common prosperity was the theme of this week, Lisa. I mean, to your point, in terms of the tech stocks, today the triggers were specifically, like you mentioned, Tencent warning there's more regulation coming, and there was also this proposal that China is looking at about making sure drivers who work for online companies get looked after better. And this fits into this idea that came out this week called common prosperity. And President Xi is basically pushing for a redistribution of wealth. This goes well beyond just reining in tech billionaires. So the tech stocks might take the headlines, but this is something of a wider fundamental reshaping of the economy that's going on. And it's all about boosting population growth, creating a more productive workforce, and of course, getting China to be world leader in so many things from manufacturing to technology. So, yeah, I would go beyond the moves in tech stocks, and I would dig deeper into what common prosperity will actually mean.
So, Enda, I'd go beyond maybe the luxury players as well. The luxury goods makers are taking a hit off the back of this. Most people attributing the move over in Europe right now to the conversation we're having. The biggest risk at the moment for investors, and it's been something that's lingered for a long time, Enda, and you know better than me, the risk of a property tax. A big property tax going through in China. Enda, can you walk us through that? What that would look like and what that could possibly do to growth more broadly?
Well, look, property, I think, accounts for the property in total as a multiplier, accounts for maybe a quarter of activity in China. Jonathan, it's a huge part of it. There has been discussion around property taxes. There's even been discussion about higher taxes in general. But I think right here, right now, the authorities might be relaxed by the fact that property prices have come off their peak recently. They're cooling a little bit, according to recent data. The authorities in Xi'an have been making clear property are for living in, not for speculation. So the fact that the steam up coming out of house prices might just take some of the steam out of that debate over a property tax as well. And as you say, of course, the economy is at a pretty fragile juncture right now. It hasn't quite pulled clear of COVID. It looked like it had for much of the past year, but it's had a scare. So I think the feeling among analysts is that tax is on the table. There are discussions going on, but maybe now it's not the right time to push that through.
And the current is good to catch up. As always, it's good to hear from you. Our Bloomberg Chief Asia Economics correspondent. 70% of household wealth tied to properties. The team at Bloomberg writing, Tom, in China, 70% of household wealth is tied to properties. If you want to do something about wealth distribution, that, without a doubt, is going to be a focus. I have no idea what they're going to do. Ender, I think, is far better placed than I to go through that. I know he is, but it's up there, Tom.
It's always been there. BNP Paribas was path-breaking on this, and a major shout-out to what UBS did with the wonderful Jonathan Anderson years ago on this. John, it's the same. My basic theme with Liz economy there is I'm not sure anything's changed in China, John.
Well, so much growth comes from property investment. And Lisa, I think that's probably the broader macro risk story here. You've got the optics on the one side. If you have an administration, the Chinese Communist Party, starting to make some noise about wealth redistribution, you don't want to be going out buying and loading up with Louis Vuitton bags, do you? You don't want to be walking around doing that kind of shopping. That's optics. Let's talk substance. The broader macro risk is that they do something on tax.
Well, and here's the question. How much tolerance do they have in the economic fallout in order to reach more socially equitable rules? And this, to me, has been the big surprise and the big sea change this year. You know, the idea that Alibaba and Tencent, two tech companies that were the pride of this country, are falling, and that the government does not seem to care to step in. In fact, they're going to double down on some of these regulatory pressures that are keeping stocks going even lower, indicates a complete shift in psychology. The emphasis has changed, and how far they are willing to go will determine the win and the loss of a lot of different sectors in the economy there in China.
Well said, Lisa. Tom, I mentioned it a little bit earlier on the program that pretty much every single slowdown, growth scare for the last 5 years and maybe longer has been born in China. And you wonder to what extent the growth scare, if we can call it that right now, I think that's up for debate still, whether the growth scare right now, to what extent that can be blamed on what's happening in the world's second largest economy as well.
For the media on a Thursday morning, it's called a growth scare because that gets people going. But John, your point is correct, is what's the durability of a growth scare? The optimists are going to talk about growthiness, technological innovation, and an ability to get beyond with microeconomics, the supply constraint, and get beyond a natural disaster, as Dan Alpert mentioned, a medical disaster of this pandemic.
Well, let's tee up the brilliant Neil Dutter of Renaissance Macro. Tom, in about 5 minutes, 6 minutes time, we'll get initial jobless claims in America, then we'll catch up with Neil. Neil's on point and has been throughout the whole of this recovery. There is a belief that goes way beyond the work of Renaissance Macro. It's widely shared that if you take anything away from Q3, you get it back in Q4 and beyond, Tom.
Well,
that's the belief. That's the consensus view.
Yeah, some of it you get back, but what I really see is the underpinning of Dutta's optimism, and he's been brilliant on that, and others as well, is technology to the fore. And I don't see technology off the rails right now, John.
Neil has been fantastic, and he joins us next. Here's the price action going into that jobless claims print in America. Equity futures are down about 31. We're negative 0.7% on the S&P 500. A couple of days of losses on the S&P. I believe we've had 5 straight days of losses now on the airlines.
I'm looking for an entry point.
And on energy equities as well. And it's that breakdown in the cyclical story that predates the Fed minutes from yesterday. We can build on that a little bit more a little bit later. Bond yields in 2 basis points to 123.33 on 10s. Crude lower by 3 percentage points to 63.44. And euro dollar basically unchanged from where it was an hour ago. We're down 0.1% to 116.97. On radio, on TV, jobless claims next. This is Bloomberg. We're live from New York City for our audience worldwide on TV, on radio. This is Bloomberg Surveillance alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Your equity market is negative, down 33 on the S&P. We are negative 0.7%, off by 0.75% on the S&P 500. Waiting for some economic data in America. With that data in just a moment, here's Michael McKee. Good morning, Mike.
Good morning, John. Well, here we go with the jobless claims numbers that everybody's been keeping an eye out for, and it's pretty good news. 348,000 jobless claims. That's down from 375 the prior week. The continuing claims number, 2,820,000. We'll get that right. The number in the headline is a decrease of 29,000 from the previous week. It's the lowest revised level, the lowest level since March 14th, 2020, when it was 256,000. So we are getting back to normal in the jobless claims data. Getting there slowly but surely. The prior week was revised up to 377 from 375, so not a big deal. And the one number that I keep following and a lot of people are looking at in terms of what the long-term impact is the ongoing claims, the total number of people who are getting claims paid right now, and that drops by 311,000 to 11,743,000 in the week ending July 31st. So overall number of people who are getting jobless claims is falling. We're going to see the people who are getting the pandemic emergency claims, the gig workers, fall off. And so that plays into the whole Fed question about tapering is what's the impact of that going to be when those excess numbers, when those excess benefits start to fall off. The other number out this morning, the Philadelphia Fed business outlook comes in at 19.4. That's down from 21.9. So a little bit of slowing there. Taking a look at the important numbers that we care about. The prices paid index, though, goes up 71.2 versus 69.7. And the employment index is at 32.6 versus 29.2. So more people going to get hired in the Philadelphia area, but they're going to be paying more for their supplies.
It's the right kind of downside surprise on claims. Let's whip through the price action just briefly. No real change off the back of this. We're down by 0.75% on the S&P. Futures softer. Lower, negative, Tom, by 33 on the S&P, and yields in by a couple of basis points at 123.33. Crude, as you were, we're negative still for a sixth straight session, down by 3 percentage points, Tom. $63.43.
Again, 30-year bond, 1.87%, gets my attention, well under 2%. And John and I are watching stronger dollar, 93.35 on DXY. He is optimistic. His name is Neil Dutta, and he has courageously carved an optimistic tone on the classic GDP formula. He joins us now on a day of a multiple set of glooms. Neil, within the GDP formula, what's going to come to the rescue? Is it the consumer? Is it investment, net exports? What comes to the rescue to give us a better than good outcome?
Well, I think it's inventories. When you look at the last ISM number, the customer inventories index, that looks at, respondents that are saying their current level of inventories are too low compared to too high. And it's basically at a record. So basically manufacturing survey respondents are telling you their inventory levels are too low. Basically what that means is they're going to be, working to fill those inventories, right? They need to get inventories into line with final demand. And while inventories, over long periods of time kind of net out to zero, they do in the short run contribute a lot to cyclical swings in growth. And that's going to put manufacturing production into overdrive. So, when you look at things like Philly Fed at 19.4, that's still a pretty healthy number. And so, manufacturing production is going to be a tailwind for economic activity. And as those inventories catch up to final demand, that's going to be a big tailwind for overall GDP growth.
I just took Philadelphia Fed folks off my terminal here back 15 years, and Neil's right, it's nicely above the long-term moving average. Neil Dutta, what is your GDP for 2021? We're seeing everybody market and market down. Where are you for the economic growth of the nation for this calendar year?
Yeah, I think like 6.5%, 7% is not beyond the realm of expectations. I understand that people are taking their forecast down for the third quarter. I think that's largely just a mechanical adjustment to what's going on with the Delta variant. So you have increasing COVID spread. People are taking matters into their own hands and staying away from restaurants, air travel, hotels, these sort of high-touch services. But, the people that I talk to have a time horizon that extends beyond 3 weeks. And, when I look further out, the 12 to 18 month outlook, can anyone really say that that's materially changed? If anything, you're seeing more activity getting pushed into that time frame.
Neil, this is such an important point. If you'll allow me to jump in. Sure. We've been talking about your point through this morning. For you and others, it's recovery delayed, not derailed. That any growth we lose in this quarter, we regain in the next quarter, in the year after that. Neil, what's the difference between a recovery that's delayed and a recovery that's derailed? What distinguishes the two things?
Well, I'm just saying there's not as much structural, changes in consumer behavior than people are expecting right now. So just extrapolating what's going on, in August isn't necessarily going to tell you much about what's going to happen next August. It may well be, John, that we're trading a bit more COVID risk now for a lot less COVID risk later. Certainly, if you look at some of the data on coronavirus, it looks like cases will probably start to peak sometime in the next week, and case growth will begin to moderate. To the extent that COVID is an issue, I think it's more of an issue in the Asia-Pacific economies, right? Australia, New Zealand, certainly Vietnam, you're seeing, and so maybe that's going to exacerbate some supply chain issues. But at the end of the day, I don't think it's going to matter much for the U.S. housing situation.
Well, but Neil, there does seem to be a 1-2 punch here. On one hand,
here we go.
No, I'm just throwing this out there.
Lisa, aren't you tired of being wrong for the last 12 months?
Being skeptical. I'm not making a market call. Honestly, it's honestly trying to come up to look around corners. Wow, you come out with gloves on. Bear with me while I try to ask my question. But just this 1-2 punch of supply chain disruptions that are causing higher input costs, in addition to a Fed that's being that much more patient because of some of the headwinds that the economy is experiencing. I mean, does this contribute to higher inflation on the margins down the line than otherwise would happen?
Well, I think it's not so much about the inflation, in my view. It's about what the Fed is going to do about it, right? I mean, I concede that point. I mean, you have had a little bit of, you could say, stagflation light concerns coming to the market. Growth has weakened. I mean, even the Fed staff took down their growth outlook and revised up their inflation outlook. We saw it on the minutes yesterday. But again, I think that's probably going to be temporary. And certainly, you have seen things like used car prices come down. I mean, if anything, in the July data, the supply chain issues were becoming less prevalent, right? I mean, if you look at housing units under construction, still going up, completions going up. So even as starts moderated, right? So that tells you that builders are working through those backlogs. And similarly, we had a nice pop in manufacturing production, driven by autos, motor vehicles.
Neil, can I ask you a question? Why does it make you upset to hear people try to come up with potential bearish counterpoints at a time when there still is a lot of pain in the economy? I mean, yes, it has been a particularly optimistic view.
My job, Lisa, is to take an economics call and help investors turn that into some kind of a market call. In other words, help them make money. So if I wanted to be bearish, I would tell people to pile. I mean, at the end of the day, it's not about what GDP is. It's irrelevant. It's using that and translating it into a market call. So if you want to go head first and buy utilities hand over fist, be my guest. But I'll be telling people to do something else. And that's ultimately how business economics, market economics, that's why it's important. A GDP call on its own is irrelevant. What matters is taking that GDP call and translating it into some kind of market outlook. So, if I'm looking at it and I'm telling, and people are saying you want to be raising cash for the last 12 months, I mean, it's ridiculous. So I think the cyclical trade is probably taking a temporary break, but this is essentially, in my view, a consolidation within an ongoing uptrend in the market.
You two should have your own show. Tom and I could just sit it out. Tom and I could just take a break. Neil Dutton, Neil, it's good to catch up. We appreciate your time. Renaissance Macro Research Head of US Economic Research. Sounded a bit testy, but I know we're all friends here. And Lisa, you do have to interrogate the bullish view just to find out what people really think. And Neil's been right over the last 12 months.
Absolutely.
He's been right to be constructive.
And kudos to him. I think that it's important, though, to have skepticism because, honestly, that is our job as journalists, as people who are questioning the common thought.
I would take this right to Jackson Hole, John. It's going to be fascinating to see the emphasis. Are
you going to give your plane ticket to Neil now?
No, yeah, the emphasis or de-emphasis. Seriously, the emphasis or de-emphasis on social economic policy. Mr. Dudd is saying he really doesn't care about it. What he cares about is economics and data. It's a boom economy. We all understand.
Yeah, but I'd go one step further as well. And Lisa will agree with this because Lisa and I have had this conversation a million times. When you're in the market and you've got to offer a view on where the economy's going, you get far more attention with these outlier calls that we're going into a bear market, growth's going to be terrible, huge downside surprise. But when you're an economist, you've got to make projections and ultimately make projections for people who want to make money. The calls that have made money are the more constructive ones. And Lisa, I think you'll agree with me on this. The more constructive view seems to attract more negative attention in the press, even though the more constructive view...
I strongly agree with that.
It's often turned out to be right.
If part of the issue is the disparity between the market view and problems in the economy that people are looking at and seeing and feeling, and they're trying to reconcile the two, and increasingly, and I think this is a really important point, the S&P 500 is less representative of the overall economy, especially with the dominance of the big tech giants. So you do have to wonder how to reconcile these two. That market call can absolutely be correct while also dealing with certain economic issues that you have to bring light to.
With every scare, though, you've made money being optimistic.
It's true.
Tom, without a doubt, bottom line.
Absolutely.
Yeah, to me, is it the need or desire of monetary authorities to craft social policy? That's going to be a debate at Jackson Hole.
I can't believe I'm leaving now, and you haven't even had a dig at me for taking a long vacation. Goodbye. Coming up on the Open, Laura Keene of UBS Global Wealth Management.
You're not in tomorrow?
My final show of the year. I'll be gone for a while from New York City.
For the year?
For our audience worldwide. I'm writing a book.
What is this, a sabbatical?
About what, Capri?
Something like that. This is Bloomberg Surveillance.
Really?
With the First Word News, I'm Laura Wright. The International Monetary Fund said that the new government in Afghanistan is cut off from using fund reserve assets. That comes just days before the nation was set to receive $500 million, and it deprives the Taliban of key resources. The IMF says Afghanistan can't use the money because the new regime lacks international recognition. In Haiti, the death toll from that earthquake last weekend has risen to almost 2,200. Meanwhile, tensions have been rising over the slow pace of aid reaching victims. They've complained of inadequate food and material needed to temporarily repair damaged homes. Shares of Robinhood are down sharply in pre-market trading. The brokerage warned that the crypto-driven surge it saw in second quarter revenue may not last. Revenue from cryptocurrency trading was up 4,500% from a year earlier. That underscores the ever-shifting preferences of retail traders. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
They didn't tell you that they wanted troops to stay?
No, not in terms of whether we were going to get out in a time frame, all troops. They didn't argue against that.
So no one told, your military advisor did not tell you, no, we should just keep 2,500 troops. It's been a stable situation for the last several years. We can do that. We can continue to do that.
No, no one said that to me that I can recall.
The President of the United States with ABC and Mr. Stephanopoulos this morning making headlines worldwide. We continue our discussion here on Bloomberg Surveillance. We're convinced that experts matter. Thomas Barfield of Boston University with us the other day. Admiral Stavridis will join us in the 9 o'clock hour. And now we are honored to bring you someone who has lived and thought more about terror, well, than anyone I can imagine. Fawaz Gerges joins us from London School of Economics. Professor, thank you so much for joining us today. I want to know what the Taliban is going to do in Herat, what they're going to do up to the north, what they're going to do in Kandahar and down to the Pakistani border. What do you predict the Taliban will do in the coming months and years?
Well, if you ask me what is the strategic priority for the Taliban, I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically engaging in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. If you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed. And that's why my take on it, I don't think we're going to see any major terrorist groups establishing a base of operation in Afghanistan, at least in the near future.
Professor, is there a risk of a Sunni-Shia civil war? If the Taliban are considered Pashtun and with a Sunni background, is there a risk of the two Islamic states fracturing this new Islamic emirate?
First of all, in the late 1990s, what we know about the Taliban, Taliban is one of the most extremist base Sunni groups in the world in terms of ideology. And we know in the late 1990s, they basically murdered many Shiites because the Taliban are a Sunni group. But again, if you listen carefully to what the Taliban have done in the past few months, they have engaged their bitter enemies. They have been talking to the Iran. Iran is a Shia-based state. In fact, just 2 days ago, when the Shiites were celebrating their basically religious annual ritual, they made it very clear that they will protect the Shiites. So no, I don't see any kind of a major rift between the Sunnis and the Shiites in Afghanistan. What I see is that the Taliban would like to change the world's view of the Taliban. They want to rebrand themselves. They want to convince the world that they are not as extremist as they used to be in the 1990s. They want international recognition and legitimacy. And this shows how clever, how strategic they have been in the past year or so.
Professor Gerges, there is a question, though, of how far they will take this stage that they're trying to get on internationally when it comes to any potential alliance with al-Qaeda or trying to root out potential terrorist groups that have traditionally used Afghanistan's soil to prepare attacks. How much are they going to push back or try to eliminate that type of threat as they try to gain international prowess?
Well, you're asking a very critical question. We think of the Taliban as a monolith. The Taliban is not a monolith, even though it acted militarily as a strategic disciplined movement in the past few months. You have some factions within the Taliban that have had some good relations with al-Qaeda, in particular the Haqqani network. But again, my take on it is that at this particular stage, al-Qaeda has become a liability for the Taliban. In fact, al-Qaeda has become a liability for everyone, including the Pakistanis. Why? The Taliban is a shadow of its former self. It has weakened greatly. It's leaderless. And also we need to think about, we keep talking about Afghanistan on 9/11. Transnational jihadism has mutated. Think about it now. Where are the groups that support al-Qaeda and the Islamic States? They're not in Afghanistan. They're in Iraq, in Syria, in Africa, in Sahel, in the Sinai Peninsula, not in Afghanistan or even not in Pakistan.
We have to leave it there, Professor. We've just run out of time. We look forward again to speak to you. Fawaz Gerges with us, with the London School of Economics, professor of Middle East politics and international relations. Lisa, I just think this is so important. We're going to drive forward the conversation with Stavridis in the 9 o'clock hour.
Well, President Biden even coming out this morning and saying that there is increased chances of a terrorist threat coming out of Afghanistan. And you do wonder how much capability a disjointed Taliban has to try to make good on some of their pledges in order to root out other fringe terrorist organizations. And this really is an ongoing threat, in addition to all of the other geopolitical concerns that we've been talking about over the past week.
Lisa, do you agree with me that the great distinction here is it's this Taliban, too, if you will, amid social media? The communication apparatus of any nation, any city, any set of tribes like Afghanistan is different than the last time around.
Yeah, one of the first interviews that the new leadership, the Talibani leadership, gave was with a female television host in terms of trying to message a different Taliban. However, the practices on the ground from reports seem to be a little bit different. I mean, this really has been a major story socially. For the markets, however, everyone's shrugging it off, it seems like, unless there's a fiscal kind of blowback with respect to Biden's agenda. A
little bit of a bid to the markets right now. We had a 24 handle on VIX, now 23.77. I don't want to oversell that right now. Futures negative 36, Dow futures at negative 330 as well. And the yield coming in 1.24%. It'll be an interesting open. You need to stay with us on television, on radio at 12 noon. The Congresswoman from Michigan with great perspective, Debbie Dingell, will join. Stay with us. This is Bloomberg.
I'm Erin Coscarelli with an exclusive Western and Southern Open update for Bloomberg TV and radio from Tennis Channel. Former world #1 Naomi Osaka made her return to the WTA Tour on day 3 in Cincinnati. The reigning U.S. Open champion fought back from a set and a break down to get past teen phenom Coco Gauff and reached the 3rd round. The 4-time major winner is playing in her first tournament since withdrawing from the French Open, citing mental health issues.
I've had a really weird year. I think maybe some of you guys know what happened to me this year, but I feel like I changed my mindset a lot. I think even if I lost, I would have felt like I was a winner. There's so much stuff going on in the world.
And don't forget, Tennis Channel's exclusive live coverage hits the air daily at 11 a.m. Eastern. I'm Erin Coscarelli.